otherwise would have to be filled with people in the U.S. who would then charge more money, and you'd end up seeing more wage inflation. It really creates this question, what is monetary policy doing? And Jay Powell was asked this, basically, how do you have confidence that this truly is restrictive? And he's like,
quits, openings, jolts.
This is what the OECD said today in their report. Immigration immigration is fueling the rebound they're seeing in rich economies. This is what the OECD pulled it down to when it comes to the supply side of the labor market in the United States. But UBS's Paul Donovan talks about inflation, how the Fed's statement is talking about their progress yet. There's not that year for the 2% target. But then he says this: it is hard to know what, quote, higher for longer is supposed to achieve. It's unlikely to bring down owner's equivalent rent or motor insurance or medical inflation, which is why the labor market and the focus on labor market has become a lot more important.
More labor market data through this morning. Jobless claims at 8:30 Eastern time. Here's the estimate in our survey, 211. Previous week, 207. Going in tomorrow, 240 is the estimate in our survey. For the payrolls, the headline number, 303 is the previous number. So the 3-month average is 270, 280. Really punchy stuff, Lisa, and we're looking for another 240 tomorrow morning.
What Andrew Hollenhorst just said, I find fascinating.
Hard landing.
I want to think about it more, because what he's basically saying is that these higher numbers that we're seeing in terms of jobs being created are masking what's going on underneath, which is a lot of weakness, and that could potentially move really quickly, force the Fed to cut 100 basis points, but even that will be insufficient to really stave off some sort of more serious downturn. This is so counter-consensus, but it's an incredibly logical argument and really would explain why you're seeing some of the cracks in certain surveys that we've been getting.
And from corporations as well.
Exactly.
Walmart, the likes of Starbucks, McDonald's. How much weight do you put on that? When it comes to Starbucks, and we know they've got their individual difficulties, how much weight do you put on this idea that the consumer in America is starting to struggle?
Well, you're seeing it not only from Starbucks and McDonald's. You could say that this is due to the protests, due to shifting habits, due to competition for $6 or $8 or $10 lattes. But there's a real question here about what we saw also from Amazon, what we've heard from a lot of other companies that say that it's clear that that consumers are being price sensitive. I think it seems like a theme. I mean, if you want to look at the beige book, it has the same kind of theme kind of peppered throughout it.
It's what Diane Swonk sent to you guys yesterday. You're seeing all these consumers, especially on the lower end of the socioeconomic scale, move from the shadows of the economy into the sun, only to get burned by inflation. That's what these corporations are talking about.
That's where the cracks are. Equity futures right now on the S&P 500, positive by 0.7%. The rally yesterday faded. We were as high as 1.2% on the S&P 500, ended the session in negative territory, so we'll see if this holds. In the bond market, yields pulling back in yesterday's session again this morning, down by 2 or 3 basis points on a 10-year at 460.16. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as Fed Chair Jay Powell keeps the door open to rate cuts. Steve Englander of Standard Chartered on more speculation of yen intervention, and Sokjen Sabantarajapa on the, quote, high bar for the 10-year yield to reach 5%. We begin with our top story. Sticking to script, futures rallying as Fed Chair Jay Powell maintains his dovish bias, reiterating policy is restrictive. Seema Shah of Principal Asset Management writing this: the constructive backdrop of solid growth, positive earnings, and prospective rate cuts has been fueling market optimism. This mix should also support a broadening of the market rally as rate cuts come closer into sight. Seema's with us right now. So Seema, let's go straight to that. The broadening of the market rally. So we heard that a month ago. Small caps got absolutely hammered, smoked in the month of April. Why does it change this month?
I don't think it necessarily changes this month, because I think the key point there is as rate cuts come closer into sight, for small caps to have a sustained rally, you need to know that rate cuts are almost around the corner, and you're very, very certain of that. So I know Powell is, of course, somewhat dovish yesterday, but as you look at the strength of the economy, I don't think anyone can have any real confidence that rate cuts are imminent by any means. So I actually think that this is going to take a couple more months than what we had expected initially for that small cap and that broadening out to really start to materialize.
We just spoke to Andrew Hollenhorst of Citi. Lisa mentioned it. He's talking about embracing a hard landing, not a soft one. Why should we do the latter and not the former?
Look, I mean, look, the strength of the economy, I can see that there are some cracks. I do believe that there are cracks forming, but they're in specific pockets of the economy. And there's kind of two key places that we're looking at that you can see them start to come through. One is, as was just said, on the lower income side of consumers. You can see that coming through in a lot of the earnings discussions. You can actually see that in some of the surveys and kind of dipping into some of the credit card data as well. But also you're seeing it on the small business side. Now, typically though, for a broad economy to do well, you just need the higher income and the large businesses to do well. So we can see cracks forming, which is one of the reasons why we expected a downshift in growth, but nothing to fall below trend. So for us, this is still a soft landing scenario, at least for 2024 and most of 25.
Seema, if Andrew Hohenhorst is right, and suddenly we do get a protracted weakening in the U.S. labor market that could even send unemployment rates above 5%, what does that do to your thesis?
Oh, then it changes entirely. I mean, we at the moment are expecting that the unemployment rate is going to rise slightly, but that's more down to labor supply. So if you get a spike in unemployment, it's not too much, or at least if you see unemployment rising to about a 5% level, 4% level, then that's a worry. But if you're seeing a spike in unemployment in the way that Andrew is talking about, then of course that's a worry, and the Fed would have to step in, and you would get fairly aggressive rate cuts. It's just that is not our scenario at this point in time.
One of the most difficult parts of this market is not only is the economic picture highly uncertain, and there's the question of which data actually is relevant or even comparable to what we used to look at, but it's unclear exactly how to hedge against certain downside risks, because you've got the potential for a downside risk of higher inflation and a downside risk of a recession. What's the best hedge for you?
Well, okay, so I think at this point in time, what we've seen in the last couple of months with the inflation data, it is a really, really timely reminder for investors that look across the diversified portfolio. I'm not saying plug everything into it, but real assets do really need to take a very significant, or at least some kind of portion of your portfolio. So stuff like commodities, infrastructure, real estate, which typically do well in high inflation years. There has to be some kind of inflation mitigation within a portfolio to have that downside protection.
You also talk about the fact that it's not just the U.S. that's hitting record highs. Where else do you like around the world?
Well, this is actually where it becomes really interesting, because typically, look, we do believe in US exceptionalism. But the truth is that at the moment, when we look at the US, there are a lot of uncertainties. We don't exactly know what the rate profile is. I think there's a lot of uncertainty at this point. The growth profile is not really looking at upside surprises. We're starting to expect some downside surprises, not major, but some. So, and then of course, valuations are expensive, which means that at this point in time, there are increasing opportunities outside the US. So even Europe, which we haven't liked for a long time, where valuations are fairly attractive, you know that there's some upside surprises from an economic perspective coming, and we're fairly sure of rate cuts. So that's one example. If you look towards emerging markets, Latin America continues to flag as somewhere which is attractive to us, as well as places like India, and in Asia, also Japan.
How much does the Fed, though, and this prolonged potential cut they're going to make it more difficult for some of these other economies?
Well, you have to be really certain of their economic strength. With a strong dollar, particularly from the emerging markets, there's always going to be some kind of negative impact, which is why you still have to be somewhat selective. There's segments of Asia which have stopped their rate cutting process or really slowed it down. We want to avoid some of those. So it has to be a convincing story. You have to have attractive valuations. And ideally, you have some exposure to some of the more secular drivers, which are going to keep momentum going, even if sometimes you get a couple of pullbacks.
Hey, Seema, good to hear from you. Looking forward to catching up in New York next time you're over. Seema Shah there, Principal Asset Management, breaking down the Federal Reserve and what it means for markets. Speaking of cracks in this company, Peloton year to date has been cut in half, basically the stock price. Right now, the pre-market is rallying hard by 5 or 6%. The CEO is stepping down. They're going to cut the global headcount by about 15%. The outlook for earnings, the full year adjusted EBITDA loss, 5 million to 20 million. The estimate loss was 62.9. So saying the right things at the moment this morning, at least, Lisa.
Yeah, and a total beat there. I mean, they only lost 5 to 20 million, or they might this year, versus the estimated $62 million loss. Here's the question. Is this a post-pandemic loser, right? That basically everyone got Peloton bikes during the pandemic. They needed to get exercise. They couldn't leave their homes. Then it basically ended up, who was it? Mr. Big, who came out and said that he still had heart problems.
Attack.
Yeah, exactly.
Didn't he die on a Peloton?
I was something.
In a movie.
Sex and the City reboot?
Yeah, I mean, this was sort of the reason why it triggered.
Matters, all right.
You're right, it was
But
the reboot.
it's the branding, and it failed. And then here's a question, or is this basically...
Peloton failed or the reboot failed? Because that failed too.
I've I've used a Peloton bike. I've enjoyed it. I think that there's a real question here, though, of just whether this is representative of a broader trend or whether this is really a Peloton-specific story.
So you were one of those people that went out and bought a bike. I did not do that.
I did not buy one.
Okay. It sounds like you did. It feels like they're unwinding because a lot of what they did during the pandemic, they thought this was going to be a big winner when life got back to normal. They're also going to reduce the retail showroom footprint. So you can actually go to these Peloton stores, check them out, potentially attract new customers because you get to try out the bike. Maybe do you want one at home? And that seems to be unwinding as well.
And they're cutting 15% of their global headcount, right? I mean, this is sort of the idea of what goes first. Well, you cut jobs. Here's the question. How many companies are there like this that built up with much bigger footprints than maybe their business model could handle? And this is sort of the washout question of, do we get more of this? Peloton might be a particular poster child, but do we get more of this as rates start to bite in a more significant way?
For big tech, arguably we saw it in 22,
Yeah.
the tech session. For these other firms, throw in the debt, Lisa. These headlines here, mindful of the timing of our debt maturities, working with banks and advisor on refinancing strategies going forward from here. We're going to hear a lot more of that, aren't we?
Which is the reason why, if you have companies that built up on cheap financing, at what point do we start to see what survive until 25? We've heard about those maturity walls that are pushed out. We're not talking about some wholesale downturn or sort of wave of defaults, as much as just simply seeing a greater pace of defaults of those companies that can't survive.
I now realize where you maybe would have tried one. They're announcing an agreement to outfit Hyatt hotels for all these Pelotons that apparently they're not able to sell to the general public.
I wish John Stolfus was still here to find out if he's got sort of an iPad strapped to a bike or something, because he won't buy a Peloton.
Not an iPad. He has sort of a digital clock.
6S.
Yes.
It's just sort of like 10
John
minutes.
Stolfus of Oppenheimer with an iPhone 6S and sort of an iPad Volume 1. Drop
Yeah,
that one?
yeah.
All right.
Game Boy.
Let's get an update on stories elsewhere this morning. Peloton right now is positive by 4%. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Unsealed Department of Justice documents show Alphabet paid Apple $20 billion in 2022 to keep Google as the default search engine in the Safari browser. That deal is the focus of the DOJ's antitrust case against the two tech giants. Regulators allege Google has illegally monopolized the market for online search and related advertising. The DOJ and Google will offer closing arguments today and tomorrow, with the decision expected later this year. Bloomberg is reporting that the FTC is set to approve Exxon's $60 billion acquisition of Pioneer. People familiar with the matter saying a decision could come within days. The deal would create the largest producer in the Permian Basin. This coming as Chevron, Occidental, and Chesapeake Energy still have large takeovers under review. And a relief, the U.S. meat supply is safe. That's according to the U.S. Department of Agriculture. The USDA said all samples of retail ground beef collected from U.S. states tested negative for the H5N1 influenza virus. The samples were taken from retail outlets in states where dairy cattle herds had tested positive for the bird flu virus. That's your Bloomberg brief. John?
Yahara, thank you. And just like that, that's what it's called. The Sex and the
Just
City
like
reboot.
that.
Right,
Oh.
just like that.
Oh,
There we
yeah.
go. Okay.
I liked the clothes, I'll be honest.
Thank you.
All right, no worries, no worries. I have thoughts. Anyway, up next, the tension for the BOJ.
Either the BOJ's policy statement isn't as strong as it sounds, or the intervention isn't ultimately going to work because monetary policy isn't going to move. And I think it's more likely the latter. Monetary policy doesn't move, so intervention doesn't work.
More signs of intervention overnight. That conversation up next. Live from New York City this morning. Good morning.
authorities.
Could face bigger challenges.
Britain's next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
Oops, we did it again.
We have a strong economy. Labor markets are tight.
We have to question, can the economy stay this resilient?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The jobs market is not deteriorating.
How long can that story keep holding for this Federal Reserve?
It's the source of this strength. We could debate it all day.
The April Jobs Report, Friday on Bloomberg.
He just missed 3 minutes on Carrie Bradshaw. That's
Jonathan
a good thing.
is Charlotte York, by the way.
That's a good thing. Equity futures right now in the S&P, positive by 0.75%. On the S&P 500, a bounce back. Yields are lower by 2 or 3 basis points. On a 10-year, a break of 460, 459.96. Under surveillance this morning, the tension for the BOJ.
There's a tension between BOJ Governor Ueda coming out saying monetary policy is not driven by the exchange rate. The exchange rate's not a target of monetary policy. Either the BOJ's policy statement isn't as strong as it sounds, or the intervention isn't ultimately going to work because monetary policy isn't going to move. And I think it's more likely the latter. Monetary policy doesn't move, so intervention doesn't work.
Adam Poston sitting down with Danny Berger and Manus Cranny. Fantastic exchange a little bit earlier this morning. Here's the latest right now. The BOJ likely conducted its second round of currency intervention this week, according to Bloomberg analysis of the central bank's accounts. The yen seeing a sharp gain in early trading in Japan moments after the Fed rate decision and news conference with Chairman Powell, but then pairing some of those gains this morning. Steve Englander of Standard Chartered writing this: the yen may have trouble retaining its gains unless there is an indication that BOJ rates policy will add support to the intervention. Steve joins us now for more. Steve, can we just start here with the intervention and then we'll turn to the Federal Reserve? What do you think the strategy is here from Japanese authorities? What is the ultimate objective, and what do you make of the approach so far?
Well, they may have thought they were going to catch the market on the hop here with the dollar kind of already a little bit weaker because of a, slightly more dovish than expected FOMC meeting. And you're intervening, or at least, the yen was moving between about 4 p.m. and 4:30, 4:45 p.m. New York time. It's a very thin market. I think that they were experimenting with trying to see whether they could create a market dynamic by having, people who sort of suddenly, say bought yen at 156, their P&L is in the red. Cutting their positions, people deciding to take profit, that their intervention would create a market dynamic that would take the yen even further down. Overall, I'd say the reviews are mixed to, slightly negative, maybe, 4.5 on the Rotten Tomato scale.
Well, Steve, I wanted to talk about the reviews and get into that a little deeper. How do you think they define success?
Well, I think they would have defined success as having the yen stay around 154 or 153, kind of stay at the lows, see some market follow through in terms of investors and others saying we had a good run, time to to stop it. I don't think that's the case. I think there's some who think that this is probably a good level to buy dollar yen at.
So, Steve, is there any idea here that maybe Japanese authorities are trying to, punish a little bit some of the short sellers that might have gotten squeezed out and hurt a little bit in the overnight action? Is that potentially one of the goals at a time where it doesn't seem like they can actually achieve price stability or true strength?
You know, these are big boys. They know what they're doing. They know, you know, what the Bank of Japan has been saying and what the policy is saying. You know, if you go short dollar yen, or go long dollar yen, sell the yen, you have to be prepared for intervention and have a risk strategy, something that tells you, okay, I'll get out here, but I'll get back in here, and hopefully I'll be the better for it. You know, I don't think the punishment was overwhelming. They may have unwound maybe, you know, 4 or 5 days of profits on selling yen. Normally, I'd say that that's not enough to have a lasting impact.
That said, Alan Ruskin of Deutsche Bank actually just putting out a note that speaks to this exact point, that there's sort of this almost intentional consequence of the Bank of Japan's actions here, or just the Japanese authorities, in terms of creating extra volatility. And this extra volatility is what makes it difficult to do some of the carry trades that have moved against the yen. Do you think that there is some sort of truth to that, that this is a Japan that would like to see more volatility in its currency compared to the US dollar, simply to prevent a lot of speculative trading?
You know, I think they can create volatility any day of the week. Whether they can keep that volatility going for an extended period, which is what would matter for these carry trades, is a different question. And often you find that investors say, okay, they intervened yesterday, they're probably not going to intervene today, and you actually see vols drop. I mean, it may not have been the case overnight, but the key is whether they can keep volatility higher over an extended period, as opposed to doing it for short intervals. And I think the market's, you know, not going to buy into that unless they see that in practice, which would mean repeated episodes of intervention.
So, Steve, basically, unless the BOJ goes on a rate hiking cycle of the likes we haven't seen for a long, long time, they need some help from the Federal Reserve and Chairman Powell. Do you think they'll get that help anytime soon? I want to repeat a conversation, just a summary of it, that we had with Citi's Andrew Honhorst earlier this morning. Andrew's looking for 4 cuts in 24. Certainly against the grain, against what's priced, and against consensus. Steve, what are you looking for from Chairman Powell? And do you think it will be sufficiently good enough to help the likes of Japan and this Japanese yen?
Well, we're looking for 2 cuts. So we're not kind of on, you know, as far on the dovish side as Andrew is. But, you know, we think that, you know, basically what the chair was saying yesterday is that he would like to cut if he could. He's perfectly happy, you know, if he doesn't have to cut, but he can keep things stable. And he's, you know, terrified of you know, any mention of raising rates at this stage. So, you know, we think that there's a good enough chance that inflation will slow down in the second quarter as it did last year, that we can get a cut in, you know, in Q3 and another one in Q4. But again, it's not guaranteed. I think there's a lot more uncertainty about, you know, whether inflation has actually plateaued or whether this was just some weird seasonality that, you know, you can't get out of these inflation numbers, and the rest of the year is going to be more friendly.
Are you prepared to say that 106 is the peak on the US dollar yet? Are you prepared to say that?
No. I mean, we think the euro is going to go to 103. So, you know, we think there's still more room for the dollar to strengthen. Not so much because the Fed is going to be that hawkish, but everyone else, you know, with the exception of Japan, of course, seems to be determined to cut rates as much as they can. And the commitments that say or implied commitments of the ECB, some of the other central banks, are much stronger, you know, than anything the Fed has said on the other side. So we think dollar's stronger through the end of the year, but maybe 2025 we get some catch up with respect to the Fed.
Got it. Steve, appreciate it. Steve England there of Standard Chartered, looking at euro dollar at the moment at about 107, 106.98, and ultimately searching for 103 on that currency pair. Seemingly for them, others too, the ECB's got more conviction about what they're going to do versus, say, the Federal Reserve.
Dramatic moves, 103. I mean, it breaks out of the range-bound level.
Lisa, we'll take that, all right?
I know, I mean, honestly, though, but it really speaks to the moment that we're in, which is basically nothing has changed dramatically. People have no conviction. They're looking for some kind of compass. So it's sort of, you know, that is a bold call at this moment.
When you head off to Europe later this summer and I offer you 103, you're going to take that, right?
I'll take that, yeah. I think that'll encourage.
No doubt about it.
Although, I would go if just short euro, long airlines that fly to Europe.
These are your trades?
Yeah.
Okay. You're actually sharing your trades?
No, these aren't trades.
Coming up, Moderna reporting a narrower first quarter loss than estimated. The company CEO, Stefan Bancel, catching up with us in just a moment. From New York, this is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
rate cut fully being priced into the market for the remainder of the year, albeit maybe a little bit more than that. So to me, this didn't reset the bar in terms of how much the Fed was going to cut. It just took away the tail risk of potentially a hike.
England is saying almost exactly the same thing. I think you're absolutely right. That was what yesterday was about, and maybe that's what the price action was about for about 5 minutes in the news conference. I still don't really know what that fade into the close was about, but we got a bounce this morning. Let's finish on foreign exchange. Dollar yen right now, 154.86. We're positive by 0.2%, so that's a weaker Japanese yen again after a much stronger Japanese yen late in the session yesterday, and seemingly the BOJ intervening. And what did England just say of Standard Chartered, that on the Rotten Tomatoes scale it would be like a 4.5? Is that what he said?
I don't watch movies unless they're above a 60% in Rotten Tomatoes.
60%,
yeah.
okay.
Do you have like a line in the sand? Unless it's like a cult kind of classic
John
for how...
loves the worse the rating, the better the movie for Pharaoh.
That's not how it works. I guess there is an inverse correlation, but I don't actively do that. I don't go on Rotten Tomatoes and put it in and see. No.
I do, and then I filter it out.
I watch a trailer and then I'll go to the movies and watch it.
Well, that's sweet.
Sometimes what I enjoy is not what, the film
movies.
critic, like the film critic who's got big ideas about what a movie should be.
Okay, that's actually very healthy.
Just want to relax.
Yeah, rather than just sort of
watch a Hallmark Christmas movie.
Analyze something.
With the same plot, and it's highly predictable, and you know what's going to happen.
Something that gives you surprises.
At the end, everyone's happy.
Something.
Under surveillance this morning. There's enough surprises on this show. Fed Chair Jay Powell sticking to his dovish bias, downplaying the chance of rate hikes and reiterating policy is restrictive. Traders turning their attention to tomorrow and the US payrolls report. The median estimate in our survey calling for a print of 240K. Before we get there, we need to talk about this. Apple reporting earnings after the closing bell. Investors looking for details on iPhone sales, which have been slowing, particularly in China. The report will also give a first look at sales of the Vision Pro, which debuted back in February. That stock is up by 1% this morning. On the session, on the year, as you know, Lisa, we are down 12%.
So Apple's going to be fascinating from 2 points of view. Number one, you've got the China question and how much they're able to continue to expand and to sell into China given the competition from domestic brands. But number two, just generally, how much are consumers pushing back against $1,200, $1,300 phones? Is that part of the reason why you're not getting an upgrade cycle? Because it's not worth it to pay that if there isn't any material hardware upgrades that you're really getting.
I feel like it all comes down to Apple, especially after Qualcomm, for China, because Qualcomm is saying that they see a robust market in China. The issue potentially is brands. And what's happening in China right now is this nationalism, patriotism towards their homegrown brands. This is what we heard earlier in the program. So Qualcomm saying, well, there's no slowdown in China. Then it goes to, well, what are you going to do about it, Apple? How do you fight that?
Yeah, and how will they talk about it? Starbucks is a decent example of this. Is it consumer preferences or just the strength of the consumer? Starbucks tried to say that it was the latter and not the former. I imagine Apple might try and say the same thing. Do Apple really want to get on the call later and start talking about the Chinese consumer? They just do not like US brands anymore. I don't think they're even going to entertain that, are they?
Tim Cook is a massive ambassador. And that's what we've always been saying. He is an ambassador between the US and China. We saw Elon Musk ditch out on a meeting in India to go over to cater to the Chinese officials.
Yep.
Do you see a similar type of tone from Tim Cook at a time where they're also trying to expand in India? These are actually really interesting nuances. People are going to be looking at this like a similar diplomatic kind of address at the press conference later.
We'll be diplomatic about it tomorrow morning. That report coming a little bit later. Moderna out already, reporting a narrower than expected first quarter loss. Cost cutting, offsetting a steep decline in its COVID business. Moderna expecting to receive US approval for its second product, an RSV vaccine, in the coming days. Joining us now is the Moderna CEO, Stefan Bancel. Stefan, wonderful to catch up with you, sir. The stock is just about positive in the pre-market. Can you talk to me about how you're balancing cost cutting with investing in innovation, given what's in the pipeline?
Sure. Well, good morning. Thank you for having me. So very pleased with the quarter. We basically try to focus on how do we drive sales, how do we drive R&D, and how do we prioritize opportunities, which is why, for example, we announced that we are stopping the partnership with Metagenomi in research in gene editing. Same thing, if you look at the portfolio, we're looking very carefully at all investments. And the good thing about those vaccines, like respiratory vaccines, is you only pay the phase 3 study once. So if you think about COVID, we still have sales from COVID, but the investment in R&D of COVID has come down a lot. As you said, RSV, we are anticipating a launch this spring, but we're not going to do another phase 3 for RSV. So you can still basically have a lot of new studies going on, reusing the capital you used to put in the other products before. And then if you look at oncology, as you know, we're in a 50-50 profit share with Merck. So Merck is paying half of a phase 3 study. So that's how we're managing. We're investing a lot in technology. You might have seen last week an announcement with OpenAI. We have actually more than 750 GPTs going, and that is helping us a lot scale the company across not only science, but also driving a lot of productivity in manufacturing, in commercial, in legal. So that's kind of how we're doing it.
So, Stefan, let's talk about something that our colleagues here at Bloomberg are extremely focused on, and that's your RSV shot, which, according to our colleagues, some data is showing that maybe it doesn't last as long as others in the market. What we all want to know here at Bloomberg is whether that raises questions about the promise of your technology in treating other diseases. How would you answer that?
So I will first say that if you look at the data, the duration of the other vaccines, they are very similar. So I don't think it is scientifically correct to say that one of the vaccine doesn't last as long as the other ones. Of the two that are approved and ours, if you look at the data. This will be debated at the CDC meeting at the end of June for recommendations. So this doesn't worry me. If you look at duration, the duration of vaccination is induced by T cell. If you look at our cancer product, the only reason it works is T cells, not antibodies. Antibodies don't have a role in cancer. It's about T cells going and attacking your cancer. If our vaccine technology didn't have good T cell response, the cancer product will not look as good as it is. So I'm not worried at all about duration.
Pretty much every time we speak, Stefan, I ask you, basically, have we cured cancer yet? So I'm glad that you went there, because that's been sort of one of the big questions and the hope for a lot of the mRNA vaccines. You have this melanoma vaccine in the works. What more do you have to do to get it sort of set up for the approval process to apply for that? And are you using artificial intelligence to expedite that?
Great question. So if you look at cancer treatment in melanoma, we've said that we need to achieve 3 things to be able to talk to the regulator about an accelerated approval. So the phase 2 data is the data we shared on the show, several times. We're seeing duration. If you remember, in December, we shared the 3-year survival. It was better than the 2-year survival. So the difference between people on our treatment and people that are just getting Keytruda is getting wider. So there's a very strong evidence that the drug is working. So that's number 1. Number 2 is we need the phase 3 study to be substantially enrolled. And so we are working very actively. The phase 3 study started 2 months earlier than planned last summer. And so when we are substantially enrolled, we will meet that criteria, and it could be later this year. And the third one is a plant, because of course we need to file in the registration dossier all the information about the manufacturing process. The FDA, the day you file, is allowed to go, of course, audit your plant. That plant is being built. I had the chance to go there 2 weeks ago. The team is working nonstop, scheduling literally by the days, a bit like we did during COVID, during the pandemic. And so I anticipate that potentially sometime next year, if a regulator was willing to look at the accelerated approval file, we should have this product available to help a lot of people, because 1 in 2 people benefit with no disease coming back or no deaths, compared to the best drug available today to them on the market.
Stefan, can you just give us a sense of, you talk about artificial intelligence, everyone's talking about artificial intelligence. Could you just talk about how much that could expedite generally some of the drug production that we're seeing, just how much that could really get us to achieve that cure for cancer, that cure for ALS, that cure for Alzheimer's? It's funny, you're talking about Sex and the City. I sit around and I worry about these things. What are we going to cure these things? So I'm just wondering, is this going to be in our lifetime in the next couple of years because of some of the machine learning?
Yes, so I think there's a few things to tear apart in your great question. First is, I think machine learning in academic labs, in research labs, in industry, is helping accelerate the understanding of a human body. If you think about, diseases like Alzheimer and other complicated diseases that we do not have solutions for yet as a society, it's because we do not understand the biology. We do not understand how the disease happen, how the disease evolve. And so we are just trying things, and some work, but very few work. Most of them don't work because we're just trying and guessing. If you look at biology, once we understand how something works, then the industry can come with very, very good actions to deal with those. So I think AI will accelerate the understanding of biology, which will be fundamental to bring new drug. Then AI is already used to accelerate discovery in terms of what tool do you go after a disease once you understand it. At Moderna already, we have different chemical matters that are generated by our AI system that are helping us to accelerate the work that humans are doing. So it's an accelerator to the teams. And then there's a huge chapter on productivity. If you think about clinical development, phase 1, 2, and 3, it's basically doing experiment in human, getting the data, finding the dose, doing more experiment, and when you have all the study done, you gather all the data and you submit by a regulator. My point, it's all about data. There are literally hundreds of business processes that need to happen. And I think many of those, if not most of those, you're going to be able to apply AI to shrink time, to go faster. An example we shared in March in our vaccine day. The team wrote a GPT to help us to do dose selection. When you do a clinical study, your phase 1, you try several doses. And then based on the data you get in the clinic, you decide which dose go into your phase 3. Well, it used to take around a month to do that by having people and meeting and experts looking at the data. Well, we developed a GPT that basically gets all the data from the clinical study and suggests to us a dose in literally a minute or two. That is already a tool that has been developed that I've seen used at the company. That's just one example. So here you go, you shrink a month. And if you do that on the hundreds of business processes that have to happen in preparing the drug for the clinic, the clinical testing, the analyzing of the data, the communication with the FDA, I think you can save a lot of time. I don't know yet, because only history will show us in the next few years. Can you shave 30%, 40%, 50% of how many years it takes you to develop a drug? I think it's going to be very significant.
Stefan, we've got to leave it there. It's fantastic to catch up with you, sir. Amazing to listen to you talk about the efforts taking place at Moderna. Moderna CEO Stefan Bancel. Bramo trying to bring up Sex and the City with the Moderna CEO. I'm not sure how that happened.
Well,
you want to bring Carrie Bradshaw into the conversation here?
when I was a kid, I did have a TV.
Okay.
And we would look at the Merck manual.
Okay. All right. This explains a lot. All right. Let's get you an update on stories elsewhere. Here is your Bloomberg brief. He had no idea what you were talking about with Yahara Hackers. Hey, Yahara.
Hi, John. The Arizona Senate voted 16-14 to repeal an 1864 law that would have made nearly all abortions a crime. The state house has already approved the repeal bill, and Democratic Governor Katie Hobbs pledged to sign it into law. Once the law is officially repealed, women in Arizona will be able to have abortions until 15 weeks of pregnancy. Shares of Shell are higher. The UK-based energy producer saw first quarter profit come in above estimates. The company said it would repurchase $3.5 billion of shares in the second quarter, matching the amount of the 2 previous reporting periods. Shell's CFO said they believe the share price does not currently reflect the full value of the company, and buybacks will continue until they feel it does. And shares of Peloton gaining in pre-market trading, the company announcing CEO Barry McCarthy is stepping down. Plus, headcount will be cut by 15%, or about 400 workers. Peloton missed on revenue and digital subscribers in the third quarter, and guidance for the full year was also narrowed below the average analyst estimate. That's your Bloomberg Brief. John?
Stock is up by 9%. It's quite a move. Yahara, thank you. Up next on the program, Chair Powell staying true to form.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman, reiterating, kind of the key point around an asymmetric response function.
Jeff Rosenberg true to form yesterday, pretending he didn't know Bob Michael's name.
You think that was just a dig,
goodness,
a burn?
Absolutely.
Bob Michelle, or if he wants to call it, Michael.
Michael, yeah.
I think it's Michele.
Sure. I think it is too. But you can write to Bob and tell him how to pronounce his name. I won't do that. That's next on the program from New York. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Equities right now on the S&P positive by 0.6%. We're up. We're bouncing back from the losses of yesterday. Yield to lower by 3 basis points on a 10-year, 459.96. Still trying to work out what Lisa was talking about before. In the FX market, a euro
Don't
negative
blame me.
by 1/10 of 1%.
She's catching up on Sex and the
107.
City.
So dark. All the stuff you start to think about, you know, pandemics, health problems.
We were talking with the CEO of Moderna.
I get it.
Okay, so
All right.
it worked.
Shots and pandemics, I get it. Under surveillance this morning, Chair Powell staying true to form.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman. He's been very much on the other side, has been one-sided, looking at the glass half full, and reiterating, you know, kind of the key point around an asymmetric response function.
Here's the latest this morning. Treasuries climbing, the 2-year yield dropping for the 5th straight time after a Fed decision. Fed Chair Jay Powell keeping hope alive for a rate cut, but leaving the timing uncertain. SocGen Subhadra Rajappa writing this: with the Fed biased to ease, the bar remains high for the 10-year Treasury yield to rise to 5% in a scenario where inflation is sticky but does not meaningfully accelerate from here. Subhadra is with us around the table. Subhadra, good morning to you.
Good morning.
It's good to see you. Did Chairman Powell just put a lid, a ceiling on yields here?
Yeah, I think so. And that's been our view all through the year, is that, you know, the front end is going to struggle to get about 5% because the market is pegged to Fed expectations. And the long end as well, because of the fact that you just don't have, you know, any clear catalyst for a sell-off or a pushback from the markets. And, you know, in an environment where the expectation is that the Fed will keep policy higher for longer, you should start to see that feed through to growth and inflation, and that would mean lower long-end yields.
Could we do some scenario analysis just for tomorrow? And forgive me for having such a short time horizon. But if we get an upside surprise on payrolls, given everything you've just said, how would yields respond to that across the curve?
I think you're going to see a bit of a sell-off. The market is not going to lean towards, you know, hikes, but I think that the amount of sell-off you see on a strong print is going to be a lot less than the rally you're going to see if you get even a slightly below consensus or a weaker print, because the bias, at least in this market, is asymmetrically skewed towards the downside.
The sell-off where? And this sort of, to follow on to what John is saying, maybe that's the case in the front end. But what about the long end? Do you see a sell-off being more significant if there is this feeling that there is more heat in the economy than the Fed is admitting, and longer term that will lead to a higher base level of inflation?
So that's a very interesting point you raise, Lisa, because one question that I've been asked, at least in the last couple of weeks heading into the FOMC meeting, is what would cause the Fed to hike? And to me, really, the one thing that I'd be watching is the rise in inflation expectations. If the market actually meaningfully pushes back on the Fed narrative because inflation is sticky, or if for some reason inflation is actually starting to accelerate, you're going to see that in higher inflation expectations, which means higher long-end yields with the front end pegged. So that is something that I'm watching. Again, you know, Powell basically dismissed any notion that they would hike. So the focus is very much on when they will cut, not if they will hike.
Is this conversation framed wrong? And this is actually something that I'm thinking about from Andrew Hollenhorst, where he came out and said, you know, this is a Fed that still is pretty hawkish. They're only going to cut once. That's what's been baked into the market, right? We're seeing at a time where there really are cracks, and they can't really get ahead of a slowdown that's already in place that could potentially lead to a high increase in unemployment. Is this market underpriced for a hard landing at a point where everybody is just sort of coalescing around, even Goldilocks is what we were hearing from Max Kettner?
So if they do have a meaningful slowdown in growth, the Fed is locked and loaded. I don't see them really being concerned about cutting rates aggressively if they need to. I think that's a good problem for them. The concern is that if you do see a 70s style, issue where inflation starts to rise because the Fed has kept policy easy, or if the Fed eases too soon, that I think is a big risk. Coming into this year, at the end of last year, Powell pivoted from a persistence of tighter financial conditions at the November meeting to an easing bias. Guess what? That led to a significant easing of financial conditions. And that led to, at least in my view, some of the services side inflation that you're seeing. So I think that a premature pivot or premature cut, I think, is a bigger risk for the Fed than if they kept policy tight and then they cut aggressively because the data wants them to cut.
Just to pick up on what you just said, the easing of financial conditions contributing to the upside surprises we've had of the year so far. A lot of people will agree with you listening. Chairman Powell didn't appear to in the news conference. How do you gauge his view of the relationship between what's happening right now on our screens and what's happening in his world?
So that's a very good question, because Powell, for some reason, seems to be concerned if financial conditions are tight. He's just completely dropped the discussion about financial conditions, even though the press and everybody else has been discussing it for the last 6 months. They only seem to be concerned when financial conditions are tight. When it's easy, they've basically ignored the narrative on tighter financial conditions. But my personal view is that I think rates where they are, 2-year around 5%, 10-year closer to 5%, is going to eventually feed through. That's what they want to see happening, is that higher yield levels are going to impact equities and other risky assets.
Where I'm a little confused is that they think it already is. And they point to parts of the economy where I think we can demonstrate it's largely been a supply-side-led rebalancing, particularly in the labour market, but yet they keep pointing to the labour market as evidence that they are sufficiently restrictive. What do you make of that?
I find that, somewhat interesting, because there is, influx of participants coming into the workforce, whether it be people coming from the sidelines into the workforce or immigration. So there are some positive momentum, in the economy, in the workforce. You're also looking at an environment where there's a decent amount of fiscal stimulus in the background that's still helping the economy. And the services side is hard, because people are spending. Consumers are extraordinarily resilient. So you really need to see a meaningful change in the job market or a slowdown in the job market, for a slowdown in the economy. You're just not seeing that in the data as it stands.
So at this point, how are you positioning? How does sort of what we heard from Jay Powell yesterday confirm or really kind of push against how you were thinking about the rest of the year in terms of an investment thesis?
I think that, unfortunately for the bond market, it's going to be a sideways trade till we have some sort of a clear indication that there's a slowdown in the economy. So my bias is still towards lower yields. I feel like the data is going to be somewhat sideways. I think it's going to be a bumpy road for the rates market, not just for Fed policy and inflation, but also for the rates market, where we see a lot of this back and forth with the data, but really the trajectory is going to be towards lower yields, especially heading into year-end. Given the fact that there's an election, I think you're going to see a little bit of a bid to quality, if you will.
Yesterday was a bit odd, wasn't it? I don't want to be too critical of Chairman Powell in that news conference, because I know that's a sport, a big tradition here on Wall Street, of which I am a signed-up member of. But yesterday was interesting, because what I was interested in yesterday was whether the disinflationary process that the chairman had believed to have started, whether it's stalled, how disrupted it is. And I don't think we really addressed that question in a material way in the news conference yesterday at all.
He seemed to be saying, we're on track. We're doing just great. It's working. It's just working a little more slowly. It didn't seem to make him question any of the broader paradigms that we're operating in terms of inflation, in terms of what's going on with the labor market. Even when he was asked to entertain those ideas, he shot it down. We're not talking about the terminal rate. He didn't say it that directly, but basically that was the presumption. Does he just not want to talk about it? Or is he just so convicted that he has the absolute right approach and it just will take a little bit more time?
This is what Mohamed El-Erian said yesterday. He had to come out and answer why. Why has it only been bumps? Why is this maybe turning into a trend? Why are you not seeing this disinflation? And he didn't answer the why.
Difficult to do in the news conference. I know every single word is so closely scrutinised by people like us, and I know it's a challenge for the chairman, and maybe this is just not the appropriate forum to do it in. I don't know, but we didn't talk about it.
I just keep wondering whether he has any hawkish bones in him. I just kind of feel like he might be one of the more
That guy back in August 2022 did. But I'm not,
Pain. It was 8 minutes.
It's like a good impression of a hawk.
Yeah.
Subhadra, this was great. It's good to see you. Subhadra Japa there of SocGen. Third hour of Bloomberg Surveillance. Up next.
The top names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
The Fed, at least in a prescient manner, said, let's be cautious here. They held back. That was good to hold back.
It's quite dovish. Market reaction, I think, was pretty appropriate given what he said.
Boy, this is really good for the markets. I actually think that's the right message.
This particular statement
is something that the markets will like. It's exactly what the market wanted.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes away from jobless claims in America. Just a flavour of the estimates for you tomorrow morning. So 24 hours and 30 minutes, we'll have a payrolls report for you. The estimate in our survey, 241,000. Across the street, some pretty big numbers. Jefferies, 280. Goldman Sachs, 275. The likes of Standard Chartered, 270. Some big numbers in the mix, Bramo, going into tomorrow.
Not to be too sort of theoretical here, but does it matter? Does it matter how big the number is? And this is what Andrew Hollenhorst was talking about. Is this sort of distorted by other trends, notably immigration, in a way that makes it so the headline number is masking something else that's happening elsewhere?
That and the fact that there is an easing bias to the Federal Reserve. And for all of those reasons put together, just had a wonderful conversation with Subhadra Chapra of SocGen. Risks are skewed asymmetrically towards lower yields. This Federal Reserve is more likely to respond to weaker data than stronger data, and setting you up for the following tomorrow morning, based on what Subhadra said, which is if you get an upside surprise, the move higher will be much less than the move lower if you get a downside surprise.
Because this is a Fed that wants to cut rates and is not concerned that their policy is unduly easy. So this raises the question, at what point is there the risk that she was talking about on the other side, that inflation concerns start to pick up? Is there a fear, especially if you get an easing in financial conditions, which is essentially what happens when you get a rally in bonds and stocks? How much do you end up sort of fostering and prolonging this inflationary cycle?
And you look to yesterday, prices paid, and John Authers talks about this morning in his column, the fact that in hindsight, it was prices paid that really was a window to that inflationary scenario we saw in 2020 and 2021, and how concerning is that for the Fed? But Powell yesterday didn't seem to even entertain the idea that there could be a scenario in the future for a hike. He said, there is a path to cutting. There is a path to holding. We'll have to wait for the data. There is no path at the moment to hiking.
If you want to get laughed at by Federal Reserve officials, mention the S word, apparently. You bring up stagflation in the news conference, they'll laugh you out the room. You noticed that yesterday?
I was alive in the 1970s. This, no stag, no inflation, get out of here. That's essentially what we heard, yeah.
Heard that from a few guests on this program as well. Just a whisper of stagflation last week. What'd you call it, stag light?
Well, I didn't call it that. Mohamed El-Erian called it that. And other people are saying the same thing, because essentially you've got slowing growth and you have inflation that still is sticky and actually coming in faster than expected. Okay, don't use the S word. But it's not a great recipe, and I think that's really what they were getting at.
Potentially stabilizing around 3 versus stabilizing around 2, which is the ultimate objective. Jobless claims, by the way, 8:30 Eastern Time, the estimate 211, the previous number 207. Equities at the moment, the scores going into all of that. Equity futures on the S&P 500 look like this. We're positive by 0.6% on the S&P. Yields are lower by a basis point or two, just about 460, a break of that level earlier, 460.78 on a US 10-year. Coming up this hour, we'll catch up with BlackRock's Gargi Chowdhury, looking ahead to payrolls, Frontier Airlines CEO Barry Biffle as the low-cost carrier reports earnings, and Laura Rame of FS Investments on her continued call for surgical rate cuts. We begin with our top story. Chair Powell downplaying possible rate hikes, but reinforcing the view that rates will remain high for longer. BlackRock's Gargi Chowdhury saying this. Chair Powell struck a dovish tone in his press conference, at least relative to market expectations. They need to gain greater confidence on the path to 2%, and for now, they expect that it will take longer than previously expected, thereby taking out any possibilities of an early summer rate cut. Gargi joins us now for more. Gargi, hello.
Hi.
Do we need that rate cut this summer to be constructive on equities?
I don't think so.
Why not?
I think that there's enough in earnings growth, and we have enough evidence from the Fed that there isn't going to be a hike this year, barring something atrocious on the inflation front, that I think equities are in a really good place. Fundamentally, we have a strong economy. Fundamentally, we have a strong consumer so far, slowing, but still in a good place. And earnings so far, as we've seen, especially in the large cap, in the high quality parts of the equity market, are doing well. So we don't necessarily need to see, many rate cuts. I think if we get 1 or 2, I think that'll be fine for the equity markets. And that doesn't mean every single day we'll get a rally, but I think over the next, 7 to 9 months, we'll be fine.
Well, we've got one right now with equities up across the board. You've been constructive for a while on the growth policy mix. I want to understand more of the growth part of the equation. We had the Federal Reserve Chair laugh at the prospect of stag yesterday, and also laugh at the amount of inflation we've got as well. Can we talk about the stag piece of this? Are you starting to see growth deteriorate? When you go across companies, not the economic data, when you look across companies away from mega cap tech, are there signs that growth is deteriorating?
Yeah, so Chair Powell did laugh at both stagflation, and I think it was a bit bold to laugh at deflation for sure. But let's talk about the stag piece here. So for you, if that means growth below potential, well, we saw that in Q1 already. For you, if that means growth at zero, we're nowhere near that. So I guess it depends on what you determine stag to be. Are we near recessionary levels? Absolutely not. Are we seeing a little bit of a slowdown from what was a very strong Q4? Yes, and I think that is to be expected. Now, when we move over to companies and what we're hearing from earnings calls and looking at earnings transcripts, I think there is a divergence again when you look at some of the smaller, more debt-laden companies versus some of the larger companies that are more able to pass on pricing power. And you're seeing that play out in the markets when you look at what small cap is doing versus large cap. So I think there is a slowdown in certain pockets of the equity market. I think that continues. And I think when you look at the higher quality parts of the equity market, at least over a longer period of time, I think that continues to do well as well.
So it sounds like you like large cap, but the broadening out trade doesn't work here, especially if you're concerned about rates remaining here and growth slowing, albeit from a very high pace.
Yeah, Lisa, when we were writing our Q2 outlook, we were thinking about what should we need to see for the broadening to happen. And one of the things that we thought about was really the Fed actually surprising with more rate cuts, sort of the regime we saw in October, November of last year, where inflation was surprising to the downside. It was a narrow path where growth remains better than expected and inflation comes in lower than expected. It was a narrow path, and now it looks like the path is getting even narrower. So for the broadening to take place in a meaningful way, I think we need to see inflation continue to decelerate even more so than what the market's expecting. And as of right now, we haven't necessarily seen that. I do think, though, investors, if you're looking for something that's outside of the large cap and quality parts of the market, look outside of the US. And the two areas that we like are Japan and India for exactly that broader access to other parts of the market story.
Okay, I'm glad you brought up Japan.
Yeah.
Does it give you any agita that we're looking at a country that's really struggling to get its currency under control?
I think that, the story is broader than what's been happening with the yen over the last two weeks or so. I think the bigger story there is that most US investors, and I would say most international investors, have been very under-allocated to Japan for the last decade. And for good reason, because there is a country where we haven't seen inflation, where we haven't seen pricing power. And now that we're beginning to see inflation come back, and of course, if the yen continues to weaken, you have that imported inflation continuing to come back, you have rates beginning to move up. All of that bodes really well, actually, for equities. Again, not a short term, but a much more structural play. And that's what I think investors should play for. And I do want to underline and underscore that this is around investors not at all being allocated. So it's a question of being under-owned versus getting back to neutral.
So you say Japan and India are these diversifiers to U.S. equity markets. Are they also potentially a way to fill a gap of individuals and investors that don't want to look at China anymore?
I think it can be one of those. We've been talking about investors moving to EM as another way of diversifying away from large cap and quality, which obviously are our favored allocations in the US market. And I think both India and Japan have idiosyncratic stories that are working for them. For India, it's an infrastructure story, it's a digitization story, it's a demographic story. For Japan, as we talked about, it's very much an inflation and a rate story. And I think those will play out in years and not quarters.
Everyone's been asking questions like, what's Fed Chair Powell going to look at in the recent data or the jobs data that comes tomorrow to figure out whether they're on the right track, whether they should cut rates, whether they should consider hiking? I'm more curious about your reaction to actually some of this data. What would you have to see in the jobs report to become less constructive, especially considering the fact that we had Andrew Hollenhorst on saying that you could see a pretty marked and sharp deterioration in the labor market?
I think what we need to see in the labor market tomorrow, and it's not just in the labor market just for tomorrow, but over the next few months, is actually a stabilization. We can't continue to see 300,000-400,000 jobs. I think we need to see a little bit of a stabilization. And more than that, I think we need to see wages. I think that's the important part. We need to see wages sort of continue to be on the decelerating path that they had been. I think if we see both of that, the labor market, the rates market and the equity market gets a little bit of confidence. I also think that even though Chair Powell yesterday dismissed the ECI that I thought was a bit strange, I still think some of the other broader measures of wages are very important. So I will still continue to look at JOLTS, continue to look at ECI, because I think those are very good indicators of how this broad, vast economy is evolving. And finally, look, CPI and PCE are going to be the only determinants of what drives us, at least as we think about our interest rate policy for the next 12 months.
I'm tempted to ask a really horrible question, because I know this is really difficult to answer. I'll ask it of Bramo first. How bad would that number need to be tomorrow morning for us to be talking about cuts in June or July? Based on the conversation we've just had, it doesn't matter how strong it's going to be, they're not going to be talking about hikes. So how bad does that need to be?
98.
Like south of 100?
South of 100,000. I would guess that would have to be some sort of real aberration with, wage declines or something like that. An unemployment rate, participation rate going down, unemployment rate going up. You'd have to see market and broad deterioration.
Gagi?
For June, I don't think it changes the picture, because they've introduced a new sentence in the FOMC statement that they would first need to take out for them to have to go in their next meeting. So I think June's out. I think in combination of a weaker payroll, so it's somewhere below maybe 125, and a weaker CPI and a weaker PCE, I think July may come back in the picture. But I think there's no way in which June comes back, because they added that one sentence around inflation, and that has to first get taken out. Otherwise, it looks too wavering on the Fed's front.
That was a better answer.
Thanks for entertaining, Git. I'll be asking that question repeatedly tomorrow morning. Gagi Chaudhry of BlackRock. Gagi, one of the best. Thank you. Thank you so much. Let's give you an update on stories elsewhere. Let's get to your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Tensions are running high on the UCLA campus. Police are currently dismantling pro-Palestinian protest encampments deemed unlawful. Demonstrators are asking schools to sever financial ties to Israel and grant amnesty to students for rule breaking. UCLA announced in-person classes will be held online today and tomorrow. Bloomberg is reporting Chinese telecom giant Huawei is secretly funding cutting-edge research at American universities through an independent Washington-based foundation. Documents and sources saying Huawei is the sole funder of a research competition that has awarded millions of dollars and attracts hundreds of proposals from scientists, including those at top U.S. universities that have banned their researchers from working with the company. Huawei is currently blacklisted by the U.S. Commerce Department. And Tesla is making more cost cuts, this time with its interns. The EV maker is rescinding summer internship offers just weeks before students were set to begin. This as Tesla undergoes massive job cuts and sees a handful of executives leave the company. Revoking internship offers is unlikely to save Tesla much money, but could impact its hiring pipeline. That's your Bloomberg Brief. John?
Yahara, thank you. Not in a position to sort of advocate for anything, but one of two things needs to happen here. Elon Musk needs a rethink. If this was his idea, don't know if it was, they need a rethink, or some pretty savvy manufacturer needs to come along and find out who those kids are and offer them a job.
100%.
Give them an internship for this summer.
Think about how desirable an internship at Tesla would be to launch a career in a whole host of potential industries.
Massive.
These are probably pretty qualified people.
Super qualified, highly educated, and imagine the companies they turned down to accept that internship in the first place.
In fact, if you're one of them, please let us know, and we are welcome to have you here. Yeah, you can come work for us.
Work on Bloomberg Surveillance. I can't promise you that's going to happen, but reach out. Up next on the program, airlines ramping up for summer travel.
I mean, demand is strong on the volume side. I would be reasonably optimistic that pricing through the summer will be up somewhere between 5 and 10% on last year.
It's about to promise a job at BlackRock, and Gagi's like, no. That's Larry's. That's up to Larry.
4,000 resumes now, because there's no way to verify who the people that
yeah, exactly. Like, who did get it? Yeah, I know.
It's over.
The travel industry and what's happening with the airlines this summer, coming up next.
heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Those applications are pouring in. Equity futures on the S&P 500 positive by 0.7%. Bramo's intern, can you imagine how depressed they'd be at the end of those 2 months?
Come on. I'd be so kind.
Existential.
World is going to end.
Here's some Merck manual.
They'll want to work for Moderna. Yields are lower by 2 basis points on a 10-year, 460.57. Under surveillance this morning, airlines ramping up for summer travel.
I mean, demand is strong on the volume side. I would be reasonably optimistic that pricing through the summer will be up somewhere between 5 and 10% on last year. There's a lot of demand. People are going back to the beaches of Europe again. I think the winter has been so awful, people need a break.
I love Michael O'Leary. Here's the latest this morning. US low-cost carrier Frontier Airlines beating first quarter earnings estimates. The company saying it's making progress on simplifying its network, focusing on growing its higher fare and underserved markets. Joining us now, the Frontier Airlines CEO, Barry Biffle. Barry, wonderful to catch up with you, sir. Thanks for giving us some of your time this morning. I'm sure it's a very busy morning for you. Could we just get some insight from you just to how the consumer is faring in America and start the conversation there? Are you seeing a pickup and acceleration going into summer travel?
Yeah, thanks for having us. Yes, we are seeing good demand, and I think it's with all this inflation talk, I think it's important to understand that while airfares may be up slightly, overall they're still great relative value, and I think they're not up anywhere near what you're seeing in Uber prices, McDonald's prices, and so forth. So it's a great value. The consumer's still very resilient, and so we're going to see really good travel this summer, I believe.
It's telling to me that you talk about the value as being really important. This is something that we see as a theme in terms of consumers pushing back against price increases. Is that something that you're seeing, that essentially consumers are increasingly searching for value in a way that you haven't seen for a number of years?
We're seeing that a little bit. We've seen it for a while, but again, airfares overall are not up that much. And in Frontier's case, our fares are actually down and our costs are down. You know, we're bucking the trend on managing costs. I mean, we are hell-bent to have the lowest costs in the country, and we did that in first quarter. You know, our costs on a state-adjusted basis were actually down 3% year over year. So those consumers are benefiting from our low costs. And so, I think it's probably the best value they've ever seen in travel today.
There's a question, especially as a lot of airlines talk about all of their costs going up and how they're actually maneuvering with bigger margins while also providing an experience that's competitive. How do you provide something that isn't just, you know, a seat in a plane that gets you somewhere, but actually is an experience that people aren't going to hate?
Well, it's funny you mention that. You know, we just launched our Upfront Plus product, which is kind of a European business class where we block the middle seat on the first 2 rows. And so great interest in that. We've also launched our premium economy seating. So we have everything you can get that maybe short of a first class seat on many of the big guys. And we offer a great experience on a brand new Airbus.
The Biden administration issued warnings last week, final rulings about automatically companies like yourself need to provide cash refunds for anything like a delay in a flight. How are you dealing with potentially these much higher costs?
Well, so actually, we are very much largely in compliant with what they're looking for. In fact, if you take the rules of what they're looking for, we refunded over $300 million in that category last year. So we don't see a financial impact from this. In fact, what we're looking to do, we're going to be launching a new website, new app, and other distribution capabilities later this year. And we think that we'll be even more transparent to the consumer, and it'll be more easy to service and get refunds as well.
Do you think the government's going too far, though, imposing these new requirements across the industry?
I think one of the big challenges is, especially with third parties, the technology is not there to do exactly the way they have written the rules. But I think in spirit, I think the industry is prepared and is in most cases like ourselves already doing what they're looking for in general. I just think that they need to be a little bit more creative and more accepting of what the technology capabilities, especially of third parties, are.
There's also a question around how feasible it is for low-cost airlines to really succeed and thrive in an environment where size matters. And there's been a real question around mergers, acquisitions. There's been the Frontier Spirit one that's been held up. How much is that going to be crucial for airlines that do provide value to continue to do what they're doing?
Well, I think, one of the things that scale gives you is the power of your frequent flyer programs. And, we look at a huge opportunity over the next several years of being able to increase our loyalty revenues. But in the size we are now, we just have much lower costs, and we can kind of overcome, if you will, that revenue deficit of the frequent flyer programs that the big guys have. But that's why you have to be low cost if you're small. And we are continuing to deliver on that with the lowest cost, and we continue to widen our cost advantage versus the industry.
Is this the model going forward, that airlines are actually credit card companies with an airline tacked on?
Well, I think if you look at the profits of some of the big guys, I don't know that they make money without their credit card.
You don't want to be a CEO of a financial institution, do you, Barry?
Well, I don't know that I would love that either. They're an industry that has a lot of challenges just like ours.
Barry, congratulations on the numbers this morning. The stock is higher. Barry Biffle there, the Frontier Airlines CEO. Their stock is up by 6.5%. I love that he referred to the European business class model, because that is the European business class model. If you fly across the continent business class, they just block the middle seat, which is what we're seeing them do at Frontier.
And that's what you're seeing increasingly, is you can pay extra to have no middle seat. So it's not necessarily changing up the planes that much. And you can also sort of adjust in real time according to demand, rather than having a built out sort of shift in the plane.
That speaks to the, was it upfront plus model that they're doing? Is that what they call it?
Yeah, I think something like that.
Pay more for more personal space.
Makes sense. To compete with, guess who? Some of the legacy carriers, the likes of United, etc., getting in on their business.
I do think it's fascinating, though, this concept of how do you compete as a low-cost airline if you're not a credit card company? Because essentially, if you think of Delta, American, if you think of United, they all are relying so much on those revenues to prop up some of their bread and butter flying strategies. So it just becomes very tricky if you don't have that size and scale, and at a time when the government doesn't really want to let a lot of these deals through.
Difficult to have pricing power without the loyalty. So you're just a commodity. So basically, you're just the lowest price. For people who are searching for a particular flight on a particular route, a particular path, and they will go with the lowest price. And if you don't have the loyalty to, say, United, Delta, American, whichever you might be a part of, if you see a higher fare but it's your airline, you're more likely to pay it. If you don't have the loyalty programs that are quite as sticky, if you're not a credit card company with an airline tacked on, it's much more difficult.
How many people, though, are price insensitive because they're paying with points? If you're paying with points, it's sort of funny money, right? I mean, it's sort of like fake. It's monopoly money.
Most people buy a ticket and then they upgrade with points.
You say most people. You're talking about yourself. Honestly, this show gets so personal with you two. Like,
oh yeah, not you at all.
Consumer trends.
Seriously, come on.
Consumer trends on Bloomberg Surveillance is just what you bought last weekend.
I mean, pretty much.
Everyone's doing it.
I mean, yelling at robots.
Everyone's doing it. Coming up next, initial jobless claims. We'll catch up with Laura Rain of FS Investments, here to react to those numbers. Looking ahead to those numbers, the estimate 211, the previous number 207. Going into payrolls tomorrow, the estimate in our survey, Lisa, 241.
You know, it's interesting. I was thinking about what Gargi was saying, which is what will it take tomorrow to really shift some of the discussion? Is some of the discussion that we heard from Fed Chair Powell yesterday in anticipation of a greater degree of weakness than we've seen in the labor market than we've seen so far?
Do you want the great conspiracy theory?
Please.
I give you like the massive conspiracy theory. And this is not a news story, it's not sourced. This is a conspiracy theory, okay? It's like they knew tomorrow's number's going to be super weak.
Correct.
Tipped off the BOJ to get in, start slapping the dollar yen down because there's going to be an open door come Friday morning for more of the same.
I saw this morning on Zero Hedge.
That's such a Zero Hedge story.
And they had it, and a lot of people believe that. So we shall see.
Not sourced by anyone, we should say.
You've done
okay?
this,
Like
you know,
that's
and
sort of
literally
like
this is going to be the lead that people take out of the show.
It's the kind of thing that TK would come on the show tomorrow morning and say, this happened. It's like, it didn't. It didn't.
Maybe.
The data's coming up next from New York. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
25 seconds away from economic data in America. Mike McKee's going to be with us to break down jobless claims. 211,000 is the estimate. The previous number is 207. A sprinkle of economic data elsewhere as well. Going into factory orders later on this morning. Then, of course, tomorrow morning, we'll get payrolls. Into that, equities are positive by 0.6% on the S&P. On the Nasdaq, up by 0.8. In the bond market, yields shaping up as follows. On a 2-year, backing away from 5%. 493.52. We're down 2 basis points. With the economic data, here's Mike McKee. Morning, Mike.
Good morning, John. Nothing new in the unemployment claims story. 208,000, a drop from last week. If the revisions come through, actually revisions are to 208. So no change at all in initial jobless claims from the Labor Department. Continuing claims do come in exactly the same. Now, what are the odds of that? 1,774,000 2 weeks ago, 1,774,000 last week. So right on for both the headline and continuing claims numbers. Non-farm productivity is a bit of a disappointment. It is up by 0.3%. The forecast was for 0.5%. And in the last quarter, fourth quarter, it was 3.3%. And that's the quarterly rate. Unit labor costs, therefore, rise a little bit more, 4.7%. That's up from a 0.4 gain in the prior quarter, and the 4% was the estimate. So what we're seeing there is some compensation wage pressures that would bother the Fed. Trade balance, $69.4 billion. That is basically in line with $69.5 billion in the initial report on that. So trade balance narrows a little bit, good for growth in the U.S., but I tell you, the jobless claims and the productivity numbers are telling two different stories to the Fed.
Rock solid on jobless claims at 208. Mike, I want to talk about wage pressure and wage growth tomorrow morning. You're familiar with this story. I think now is the appropriate time to have this conversation before we drown in all the numbers tomorrow. The minimum wage hike in California for fast food workers to, I think, $20 per hour. Mike McKee, I think the first month that gets pushed in April. Are you going to see any shifts around that story because of that?
Generally, we don't. It's been the case in the last couple of years that we've seen a number of states raise their minimum wage, and studies have shown it doesn't push overall wage levels up all that much, in part because it's the minimum wage. There is maybe over a period of time some marginal change, because if you're raising the lowest wage rate, you also tend to push up a little bit on higher wage rates. But in general, it's not a big thing, and we probably won't see much of a change in that.
Mike, I imagine you want to address the conspiracy theory that we've been entertaining for the past couple of minutes, this idea that maybe the Fed knew something that we didn't about the numbers that we're going to get tomorrow, that there's going to be some weakness. Do you think that there's any credence in that? These jobless claims are a head fake, that they showed strength, and yet we're going to see weakness tomorrow?
Well, I don't think they're related. Jobless claims are layoffs, and the numbers tomorrow are hirings. And so it doesn't necessarily mean that the two things are going to move in lockstep. We should see higher jobless claims if we're starting to see lower hiring. But so far, no lower jobless claims. I think the conspiracy theory is just that, a theory. I heard you talking about how the Japanese might be let in on it. I do think that the Japanese planned their intervention yesterday for after the Fed meeting, because it's interest rate differentials that are driving the yen. And so if the Fed did nothing and sounded somewhat dovish, then they get a little bit of a tailwind when they intervene.
I've got a great message regarding that conspiracy theory. It's time to start writing spy novels with that take. Mike, can we talk about your impression of the Federal Reserve yesterday? You were in the room with Chairman Powell. As you wake up this morning, what still stands out for you?
Well, I think the biggest thing, John, is that the Fed is trying to live up to its mandate of full employment and price stability, but they don't know what's going to happen. They have much less visibility on what the pattern, the trend is going to be over the next couple of months. So they don't know what they're going to do. And Jay Powell's trying to walk a very fine line. He doesn't want to encourage people who think they're going to raise rates. He doesn't want to encourage people who think they're going to cut rates, because they don't want to be caught offside and push the markets one way or another, which makes everybody in the markets unhappy because they want to know what the Fed is going to do. And it's hard, if you don't know what you're going to do, to let people know what you are.
We want tomorrow's prices. Mike, that's always the way. Mike McKee, thank you, sir. Breaking down the economic data. 208 is the number. 211K was the estimate. The previous number also 208. Right in line with where we were last week, apparently, which is kind of odd. Elsewhere, looking at the price action, equity still positive by 0.6% on the S&P, up by 0.9 on the Nasdaq 100. On the Russell, the small caps bouncing back by 1 full percentage point. Yields stay lower just a little bit, but I have to say that move fatally. So we're down about a basis point on a 10-year at 462.
People really wondering what happens, especially longer term, if inflation really does potentially stay sticky. I'm actually more interested in the long end. And we were talking about this a lot yesterday and some today. The long end of the curve actually is seeing much more of an increase. The short end, which seems pegged by a Federal Reserve not willing to hike rates.
I totally agree with you. That's what's interesting to me. This conversation we had with SocGen Sabater Japa earlier on this morning, if you missed it, it's worth going back over. That risks are skewed asymmetrically to lower yields because this Fed won't respond to stronger data in quite the same way that it will to weaker data. Got all that, okay? So just an example of that tomorrow, some scenario analysis for you, get an upside surprise on the payrolls report, maybe you move 5 to 10 basis points on a 2-year higher. Get a big downside surprise, you could have a move of anywhere between 10 to 20. That's just an example. Got it on the 2-year. On a 10-year, gets a little bit more difficult. If it's a Federal Reserve that's willing to let inflation run, willing to ignore hot growth prints, I don't know, payrolls tomorrow, what happens with the 10-year yield is less obvious.
Especially given the fact that we're just shrugging off 208,000 and this sort of stability in terms of jobless claims. We're seeing continuing claims go down. We don't think anything of it. It doesn't register anymore because we have gotten so accustomed to just stasis, this sense of just calm. This really does raise a question. What are we missing that they seem to be seeing?
Lara Rame joins us now to explain of FS Investments. High bar, Lara. Let's start with this. We'll go to the economic data first. Your impression of what we got from jobless claims, your reaction just moments ago.
I think if you put me on a desert island and told me I would get one economic indicator, it would be initial claims. And I think until that really moves significantly higher, it's hard to get too nervous about the health or the state of the labor market. It looks like we're still really looking healthy. That foundation for the economy is solid. And look, one of the things the Fed didn't spend a lot of time talking about yesterday is growth, which just seems to be firing on all cylinders and is kind of off the radar.
And yet when he was asked about being sufficiently restrictive, the first thing he pointed to was the labor market, Lara. Make sense of that, please.
That actually did surprise me because while the JOLTS numbers have come down, I really see that as renormalizing. I mean, we're still far above where we were before the pandemic. I think that we need to draw a huge distinction between renormalizing of the labor market and weakness in the labor market. Even if we were normalized to where we were before the pandemic, that wasn't a weak labor market. So it's been a long time since we've seen that happily. But to me, that, is really not what is driving markets today. The data that's moving us seem to be the wage data. And in the employment side, the monthly payroll numbers. Of course, it's always the big show.
Well, this raises this question then, what on the margins has changed for you, Lara? If you think that those inflationary pressures still remain, if you think that the strength of the economy is the one consistent thread through all of this year, then are you on the margins not liking longer term debt quite as much as you used to if you're concerned about this idea that inflation could be sticky?
I think your discussion leading up to this was exactly right. I think from here for some time now, we're going to be probably in this holding pattern of the Fed funds rate kind of where it is, and the action and the market focus and the volatility are going to emerge in long-term interest rates. The problem with, having no real consensus on when and where the next move is going to be means that every data point is a flashpoint to fill that vacuum. And so when I look at long-term interest rates, I still think that the 10-year retests that 5% high from last year. And when people ask me, why do you still have one why do you still have one rate cut priced in for this year? My answer is, I think the condition for that would have to include long-term interest rates rising more quickly than the Fed is comfortable with. I think under that condition, along with some easing in the inflation numbers, would potentially cause the Fed to do that surgical rate cut in the fourth quarter.
We've been playing with this question, and this was the first question that Jay Powell was asked yesterday, which is just simply, is this a sufficiently restrictive policy? He said, yes, this is restrictive. How do we measure that? How do we know when we hit that trigger point, if you sort of have conviction that at 5% you start seeing that cracking a little bit more?
Yeah, there's no thermometer out there that we can all look at, because you look at equity markets and I would say we're pretty, expensively valued. I think that reflects a lot of optimism about growth, and that seems to have comfortably overshadowed this move higher in long-term interest rates. It's hard for me to look at financial markets, credit markets. You kind of go around the room and say, things don't feel that restrictive. Again, the economy, I would push back on that. Far be it for me to take the other side of Jerome Powell on an argument on the economy. But from where I see it, things are not terribly restrictive. They're still tapping on the brakes. You see that in some sectors like housing. But, listen, housing is under pressure for the supply side and the demand side. It's not just a rate story there.
When are we potentially going to see a true renormalization of labor market, in the sense that, how do we talk about renormalization when the supply side is so different than what we expected? CBO thought it'd be 1 million people last year. It's actually 3.3 million people.
Yeah, I think that is a critical question, and it has big implications for wages as well. We forget that it's a very different backdrop of labor supply than we had, and we've also seen a lot of migration that has still meant that the skew of wages is very different across our country than it looked prior to the pandemic. I think all of these things we're still navigating, and we are seeing, that kind of normalization in that beverage curve. I know that don't mean to go too far down a rabbit hole, but some of those things which measure wage pressure versus the layoffs and the labor availability. So when I sum it all up, another big number, the unemployment rate's been below 4% now for 2 years. Again, as the process of normalization continues, it's hard to get worried about how it's all evolving.
If you want to get worried, Laura, a lot of people look to some of the conference calls of executives of big businesses that have been talking about consumers starting to push back, layoffs potentially around the edges. We talked about Peloton, an idiosyncratic stock, albeit. How much do you pay attention to these calls and see that they are actually reflecting weakness that gives you a little bit of pause?
I think you have to pay attention to the calls. The corporate animal spirits are certainly driven investment over the last 10 quarters now, which is positive. So if that changes, I think it does take us from, a high growth situation to sort of a medium growth situation. I also note consumer delinquencies, which, autos, credit cards are pushing at highs that we haven't seen since sort of the end of the financial crisis. Our economy is strong right now. The labor market is healthy. This should not be the time that households are having problems paying their bills. So that's something that I'm also watching really closely. And, we've been expecting consumer spending to slow for a while.
Yeah.
I think the worry is that instead of slowing slowly, it really just stops. That would be much worse.
That would be a whole lot worse. Laura, thank you. Laura Rain there of FS Investments on the consistent contradictions in this economy. To have one comment there, just one single passage, to say delinquencies are the highest on some measures going back to the financial crisis, yet the economy's rock solid. Can you make sense of that? To say that at the same time?
This is a reason why you get two people on. They've got completely different views of the economy. If you think about where we've been in this show, 3 hours. We had Andrew Hollenhorst talking about 4 rate cuts this year, talking about a recession, a hard landing, and talking about some of the anecdotes pointing to that. Then we talk about this with Laura, and she's like, it's very hard to find cracks. Even putting those things aside, those are small segments of the society.
It's been a long 3 hours, hasn't it? Equities right now positive by 0.
I'll let you answer that.
0.8%. The opening bow just around the corner. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. Novo Nordisk raised its annual profit outlook as more patients get on its weight loss drug, Wegovy. The drug maker said more than 25,000 patients are starting on the treatment each week in the U.S. That's up from 5,000 back in December. Shares of Novo Nordisk have surged more than 25% this year. Shares of Carvana are higher in pre-market trading. The used car retailer posted net income of $49 million. Analysts had expected a loss of $116 million. Vehicle sales grew for the first time in 6 quarters. The results could be a signal that the once nearly bankrupt company is moving past its restructuring plan and into a growth period. And Apple is set to report earnings after the closing bell. Investors will be looking for investments in AI and details about iPhone sales as demand in China slows. It will also be the first official report showing sales of the Vision Pro. Analysts estimate revenue fell 5% for the last quarter. That would mark the 5th decline in the past 6 periods. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the labor market staying strong.
I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market.
We'll start with the labor market next. Looking ahead to payrolls tomorrow morning with the opening bell 45 minutes away.
Did you decide?
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Yeah, from about just around the corner, 43 minutes away. Equity futures on the S&P positive by 0.8%. Under surveillance this morning, the labor market staying strong.
I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong. The demand side of the labor market in particular, it's still higher than pre-pandemic, but it has been coming down. That's demand cooling.
Apparently that's demand cooling. Here's the latest this morning. Futures are up by 0.8% on the S&P. On the Nasdaq, up by 0.9%. Jobless claims pointing to continued strength in the labour market. The payrolls report tomorrow. The median estimate in Bloomberg's survey, about 240K. Bank of America's Savita Subramaniam saying this: there is a strong case to be made for better times ahead. But positioning is still defensive, with investor ethos swinging from recession to stagflation with no stop in between. We're constructive, with an S&P 500 forecast on the S&P of 5,400. Savita joins us now. Savita, good morning to you.
Good morning.
Which one is this? Stagflation, hard landing, no landing? Where are we going?
I think we're going to a soft landing with a reasonable market environment, maybe better growth ahead than what we're used to, higher rates, a little bit higher inflation. But look where we are on inflation. These are the levels that we all used to write about as the Goldilocks levels, right? We're not at 9, we're not at 0. we're around 3 or 4. Those are healthy levels for equities.
It doesn't sound late cycle when you speak. Where are we in this cycle?
Who knows? I mean, I think this cycle is very asynchronous, if you will. So it's, you know, there's some areas that are booming. We're still kind of coming off of COVID. So we've got services demand maybe slowing or tapering off, goods demand potentially picking up. We've got still tight employment. But then there's also a couple of structural factors that I think are skewing the cycle call. So we have a very tight employment market. And one of the reasons for that is demographics, which we're in an aging demographic scenario. And then on top of that, we had a huge number of early retirees during COVID. Unless we loosen immigration, I think that we're going to remain in this very tight labor market. So that's the other factor. And, you know, we've talked about this. I think the consumer is in a very different balance sheet setup than in prior cycles where, you know, long-term fixed rate mortgages, 85%, very different from prior cycles. You've got baby boomers sitting on wads of cash. So I just think that this cycle, you can't just map on the typical, you know, oh, the Fed is tightening. It's, you know, we're late cycle. Now the Fed has stopped and they're going to start cutting. We're early. It's a different type of market.
You use the G word. Sorry, I apologize to fans. It's been a long week. Goldilocks. And we heard this from Max Kettner too. And this really raises the question, can we have Goldilocks with 5% Fed funds rates? Is this actually just a new rate? Is it not actually restrictive? And is it something that can actually even allow a broadening out in a rally, even without any rate cuts this year?
I think so. I mean, I think there's a very high probability that the Fed remains on hold. Our economists have talked about this as well. So we expect a cut in December, maybe no cuts. Look, I think 5% is a manageable number, especially if you have corporations that have locked in fixed rate, you know, long-term debt. You've got, and this is the S&P, not necessarily small caps or other regions, but I think that the S&P has actually prepared for this moment. Now you've got big tech companies, the go-go growth stocks, initiating dividends, right? We've got an environment where the market is adapting to higher interest rates, shortening their duration, giving us more cash. Like, I think this is actually a kind of a reasonable setup for equities here.
I don't want to be cynical. There is this concern with people focusing on large caps that can handle this. The people shrug off the highest delinquency rates going back many years. This idea that if a number of people just get blown out, fine, it's okay. You know, we can just go into luxury. We'll go into big tech. We'll go into the areas that'll do fine, and we'll be fine, even if other segments are getting kind of blown out.
Right.
How long can that go on?
I think that is a key risk. And I mean, we've seen that income gap widen for decades now, right? I think what's happening now is actually potentially better for the middle to lower income customer if you're in certain sectors. So look at manufacturing in the US. There's still a very tight labor force. Real wage growth is positive. Where you're seeing a lot of the layoffs is more in white collar, you know, not necessarily middle America, where you're seeing still very strong signs of this reshoring boom that has a long tail, right? I mean, you can't build a factory in a year. It's going, this reshoring theme is a very long-term theme that I think has legs over the next several years. And that's where the job tightness is. That's where the real wage growth is really positive. And I think those are areas that are, you know, different from where we've seen benefits in the past. So that's one way to stave it off. And then, you know, I think higher oil prices are also a concern if you think about geopolitical risks. But where we are today is, I think the U.S. is in a better position because we are now a net exporter rather than. Right. So I think that where we are now is an environment where we really do need to see some of these inflationary forces subside. And where I think there's a couple of things going on that could actually continue to create a ceiling on inflation. So think about it. There's still demographics, and demographics. We've got aging population, less demand for stuff. That's sort of a disinflationary pressure. You've also got disruption from AI, tech, automation. So that's a continued disinflationary pressure. I don't see inflation going to the 70s levels. That's really untenable for your average consumer. I think there's enough of a secular disinflationary force at play that we've all been talking about, you know, for the last 20 years, that can actually stave off a really aggressive level of inflation. And then on top of that, I think the energy independence of the U.S. is a really important factor because, you know, that's a benefit to the U.S. that most other developed economies don't have, and I think that's something we should be happy about.
Let's finish on something you've been focused on for quite a while, old economy value. Energy, industrial, starved of capital. I remember you outlining this, I think maybe 12 months ago. Still a big theme for you and the team.
Yeah, and it's worked for maybe 2 months out of the last 12. But, you know, I think where we are now,
I wasn't throwing mud, just for the record. I was genuinely interested in the thesis.
Well, you know, again, I think we're in an environment where the broadening of the market is still a theme we talk about. And it's started to happen in the last couple of months. Look, who's going to benefit from all these chips and this AI and, you know, automation? It's old economy companies that get more labor light. And I think that's the benefit that we could see over the next, you know, 12 to 24 to, you know, few years. And I think the areas are, you know, industries like ours, the banks, right? I mean, banks are very labor intensive. Now there is this tool that we can use to replace people with bots and processes, et cetera. So I think, you know, it's a potential streamlining or cost-cutting story, self-help for a lot of these old economy services sectors that haven't really addressed their labor intensity for quite a while.
Savita, this was awesome. It's good to see you,
Great
as always.
to see you.
Savita Subramanian there of Bank of America. We had that conversation with Brian Moynihan himself over at B of A about a month or so ago.
Yeah, the good news for people who work at Bank of America is the people who are employed will get paid more. There'll be fewer of them, but they'll get paid more. Exactly.
Right?
So there is that upside.
Just remind them of that at the end of the year. All right. Coming up tomorrow, here's the lineup for you. Sarah House of Wells Fargo, JP Morgan's Priya Misra, Nadia Lovell of UBS. We'll catch up with Mohammed Al-Erin of Queen's College, Cambridge. The perfect jobs lineup tomorrow morning. Lisa, the payrolls report just around the corner.
And how much is this basically setting up for a massive rally either way? Because basically that's what we heard from the Fed, and that seems to be what everyone's geared up for.
Win-win, apparently.
Evidently.
From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
From New York City, for our viewers worldwide, I'm Danny Berger. We are set to open higher this morning. Powell's out of the way. Next up, it's Apple after the bell and jobs tomorrow. The countdown to the open starts right now. Coming up, futures moving higher after another round of economic data. Fed Chair Jay Powell keeps the rate cut dream alive, and investors look ahead to payrolls with Apple earnings on deck. We begin with the big issue. The Fed holds again.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
The Federal Reserve is not living up to the commitment on inflation that other central banks are.
Let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here is a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
An FOMC and Powell that toes the line and doesn't rock the boat. Joining us now is Bloomberg's Liz McCormick, Chief Correspondent of Global Macro Markets. Liz, thanks for joining. We're 19 hours out from the FOMC and Powell's press conference. What is still lingering in your mind at this point?
Yeah, and what a great lineup of speakers you just went through. Yeah, I think, like Bill Dudley and another part of his clip, he had said, Chairman Powell basically said, we got this, and I think what's lingering is, I think the market heard him. They cut off the option of a hike for now because he really slapped that down clearly. But it's really going to be depending on the data, right? Of course, Powell will do and the Fed whatever they need to do. So we had some data today. Some of the cost indexes were a little higher. Jobless claims are hovering, at not troublesome levels. But the market still has yields down a little bit. So I think, we got the piece that their easing bias remains. We have jobs data tomorrow, like you've mentioned. So I think there's just going to remain a lot of angst in trading around these numbers because they know, despite what Chairman Powell said, if the data changes, they will change their tune. I'm not saying they're going to hike, but now there's price for just one full cut, which has been the case for a while. And whether that gets pushed out or not, or they price in the chance of a better chance of two will really depend on how the labor data, the inflation data goes out to the next couple of weeks.
Hey, Liz, we appreciate it. Bloomberg's Liz McCormick there. Let's widen out the conversation. Joining us now is Mona Mahajan, Senior Investment Strategist at Edward Jones, and Peter Shear, Head of Macro Strategy at Academy Securities. Peter, we had a Powell that was very careful not to pull a Williams, if you will, and introduce the possibility of hikes. He stuck to the line. We're going to be cutting, but we don't know when those cuts are going to happen. What did you make of his performance?
I think it was decent, right? He really is focused on the ability to cut. That's where he wants to go. He's trying to keep that on the table. I thought he was a little bit disingenuous when he starts talking about the lag in rental income. He tried to go and explain that, in rental inflation. yeah, we probably understated rental inflation for years, and that was probably one of the reasons they were slow to react. So I guess it's good that they're learning from their lessons when they were calling things transitory. So some of these lag effects, I don't buy into that. I think we're going to struggle on the data. I think we probably get a few good prints that probably gives the market hope that we go back to 2 cuts. So I'm still stuck in the 2 camp. I think he still wants something in June, July.
Mona, what about you? Are you in camp 2 cuts after Powell as well?
Yeah, you know, look, I think Powell summarized it well when he said he doesn't see the stag and he doesn't see the inflation. It really kind of revealed his cards to some extent. He really does think that inflation will moderate over time, to Peter's point. He sees those lag impacts from shelter and rent playing through. We do think that there hasn't yet been signs that inflation is reaccelerating. That is the one thing that has given us some comfort. We think that they are biased to cut, and we do think at least 1 cut is coming later this year. Keep in mind, this is what's supposed to be a multi-year rate cutting cycle. So it wasn't just 2024, they had outlined 25, 26. And so as we gradually move towards a more neutral rate, we think that's really where we start to unlock some value. Perhaps it doesn't come 2024, but we think over time we get a better rate environment overall.
Not only was his bias towards cutting, but the bar for hiking was extremely high. If I can read to you both something Powell said yesterday, if we have a path where inflation proves more persistent, where labor market is strong, and we're not gaining greater confidence, that would be the case where it would be appropriate to hold off rate cuts. I mean, you could have easily have taken out hold off rate cuts and stuck in instead hike rates. Peter, is this the Fed put? Is the Fed put back in the room with us and alive? Is this a Powell who doesn't want to upset markets and push yields higher?
Yeah, I think that's generally true. I think the Fed put's kind of there. We talked about this, I think, late last year, right? I think he was very happy to cause a recession in 2023. It wasn't an election year. He does not want to go down that path. So there is some support there. They are starting the process of reducing QT. That should be somewhat supportive. So he's doing things. I think he's looking for the data. He has maybe got his fingers crossed that it all comes together so he doesn't have to hike, because it is going to be a very, very high hurdle for them to even think about hiking. So, yeah, we've got a little bit of comfort there, I think, on the rate side, but I think it's going to extend much more to the 2-year. I think we're going to get back to worrying about the deficit, and we're going to see 10-year yields push higher, regardless of what Fed policy is going to do, because this is a story going to be about deficits and ongoing Treasury supply, not about where the front-end rates are.
Mona, if you look at all that, you put that all together, what Peter is talking about, I understand why you trade the 2-year in that way, of trading according to deficits. But if you look at duration, if you look longer out, it's a head scratcher. How are you supposed to trade a 10-year where you have a Powell who will not talk about hikes? So when hot data comes in, what do we do with that?
Yeah, you know, look, I think there is really a tale of 2 narratives here. One is that inflation is stickier than we would like it to be, and it's taking longer than we'd like to move lower. But the other narrative is really around the U.S. economy holding up better than expected, and that narrative has played out. We have seen not only economic growth hold up, we're starting to see earnings growth continue to perform and even exceed expectations for the first quarter. So the growth narrative remains intact. For stocks and even bonds broadly, the 10-year to your point, they will react more to what's happening in underlying economic growth and underlying earnings growth. And so we think if that story continues to deliver, we do think that the 10-year will probably be getting close to some sort of peak level in the next 6 to 12 months. That is an interesting opportunity for duration broadly. We do think that if we think about historically the best predictor of future bond returns and investment grade bond returns in particular has been the starting point of yields. And so if we think we're getting closer to a peak level in yields, we do think that extending duration, or at least not being so overweight cash and cash-like instruments, starts to make sense in the year ahead.
There are a whole lot of people in cash, Mona, that need to be talked down from that. But when it comes to the equity, Mona, that you talked about, that it can do well if there is growth, if that's what's driving yields higher, what do you say to those who say bond markets have done their job of pricing out some of the cuts that we had in, but equity markets still haven't woken up to that? Is there any sort of repricing that needs to happen even if the economy is strong?
Yeah, you know, I think thus far we still haven't seen that notorious broadening of market leadership. It's still been pretty concentrated in the mega cap technology space on the equity side. And that makes sense given yields have remained higher, inflation has been sticky, we are higher for longer on the Fed narrative. But we do think the catalysts that will unlock value in terms of this broadening of market leadership, where we do see cyclical parts of the market, value parts of the market, those with better valuations broadly start to play some catch up. That will come as we get closer to this potential Fed rate cutting cycle, as inflation hopefully does play some catch up, and instead of seeing overheating, we get some prints that are below expectations in the back half of the year. And by the way, growth in that environment can continue to perform given inflation's coming down, rates are coming down. We see economic growth and the consumer holding up better in that environment. So broadly speaking, we are still pretty concentrated in the equity world, but we think that broadening of market participation will play out in the months, probably 12 to 18 months ahead.
Peter, what say you, broadening to come?
I think so, though I think first we get a bigger pullback in QQQ, so the NASDAQ 100. I think if you look back, right, really the market hasn't done much since the end of January. So we kind of had the start of the year, a really big spike in stocks, but it's kind of settled in from there. It's had some weakness. I think we're going to squeeze out some of what I think are excesses in the AI. I think as people are working through the cost-benefit analysis, I think we're going to see a little bit pullback in those AI type of stocks. We're going to see that pull down. Until we see that pullback, I'm not that comfortable with the Russell 2000 or those stocks really performing well. If anything, I've been looking at China. I think, I think longer term, I find China uninvestable. I think we are separating from them. But you look at their stock market, it's really outperformed since February. I think there's a lot of upside still to whether it's FXI or KWEB as their economy gets back on track. And I think the biggest mistake people are thinking about right now, maybe incorrectly, is they view an improving economy in China is going to be good for U.S. stocks. I don't think that's going to be the case. I think an improving China economy is going to be good for Chinese stocks because they're buying more and more of their own brands and they're starting to try and export those brands. So I think it's a very different dynamic than we had the past 2 decades. So that's why if you think China's doing better, own FXI or KWEB, don't own U.S. stocks because that transition's not going to be what it once was.
Peter, on the point of earnings, you noted this in your notes that we've seen the big tech stocks over the past 2 weeks swing some 10%. These are stocks that are trading maybe not even like small caps, something like penny stocks. You flagged the concerns about liquidity. Tell us about them. How concerned are you?
Yeah, I'm very concerned. So, I traded credit derivatives throughout the financial crisis. And what was always reminiscent then was you had these air pockets, right? Something would trade here and it would seem very liquid. All of a sudden, whoops, it would appear here and get liquid again. And I think we have so much electronic trading, so much algorithmic trading, so much cross-asset trading. That's what we get are these air pockets. And I think we're probably going to rue the day that we really went towards weekly and now daily options. I think those are accentuating these moves. So it can happen in both directions. So don't get me wrong. I think it's allowed markets to go higher than they would otherwise. But I do think we're now very susceptible to a sharp, fast decline, almost like we had post-FOMC yesterday, right? We were sitting up 200 and something on NASDAQ and finished the day down, and it was a one-way street with very little true depth of liquidity. So I'd be cautious, and I think there's a lot of potential movement, and it does scare me because it seems unusual for trillion-dollar companies to swing 10 and 12% in a day on a regular basis.
Well, lucky for you, Peter, the NYSE's looking at 24-hour trading. So yay, more fun times ahead in that lack of liquidity. Hey, Mona, Peter, you're going to stick with us. Now, before we get back to them, let's take a quick look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Hey, Danny. Well, one stock that's absolutely soaring, Carvana, up the last time I saw up more than 30%. This after the online used car dealer reported a surprise profit. Wow, at this point up nearly 40%. Analysts really like the unit growth acceleration. I would point out that there's a 28% bearish short interest here, so today's move up is probably largely a squeeze. Qualcomm up 6%. They offered a strong forecast on good smartphone demand, Androids in particular. Etsy, on the other hand, down 16%, demand lagging, and you can see that stock down sharply.
Abigail, appreciate it. Abigail Doolittle there. All right, coming up on the show, Japan spends $23 billion in the latest yen intervention.
Either the BOJ's policy statement isn't as strong as it sounds, or the intervention isn't ultimately going to work because monetary policy isn't going to move.
Some wild swings. We're going to look at them and the yen next. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
There's a tension between BOJ Governor Ueda coming out, as he did at Pearson Institute a week ago Friday, and the Diet last week, saying monetary policy is not driven by the exchange rate. The exchange rate's not a target of monetary policy. We're ready to raise rates, but we don't have to do it quickly. I'm paraphrasing.
Right.
Yeah. But you know, and the intervention. And so either the BOJ's policy statement isn't as strong as it sounds, or the intervention isn't ultimately going to work because monetary policy isn't going to move.
It's just the second time in a week. Japan conducting intervention. The latest entry this time was around 3.5 trillion yen, or about $22.5 billion. The move is an aggressive stance from the finance ministry in what could be a prolonged fight to support the currency. Let's get over to Bloomberg's Enda Curran. So Enda, we got the counts this morning. We got the data. What did we learn?
Well, so it looks like it has been the second intervention this week, as you mentioned, Danny, choosing to come in after the Fed meeting, choosing that window of opportunity there when Chairman Powell was sort of sending those dovish signals in terms of where U.S. policy will be going eventually. And they seem to have some initial bang for their buck. Now, the finance ministry in Tokyo has not yet confirmed that they have intervened. They didn't confirm earlier in the week either. The thinking there is they're just trying to keep markets guessing, keep them wary. But our colleagues in Tokyo who run the numbers on the published Bank of Japan accounts say it points towards the BOJ stepping into the market to buy the yen. And the price action would certainly suggest that there was some kind of a major trader making some moves around that time. The bigger question, though, is, as Adam Posen mentioned earlier, ultimately how successful can this be given the divergence between policy in both the U.S. and in Tokyo?
Right, and Adam Posen, in that conversation I had with him, was basically saying that, no, it's not going to be successful, and as long as monetary policy stays as it is, stays easy. Is there almost a contradiction then with a Bank of England governor, Bank of Japan governor, who talks about the easiness and not targeting any FX level, and then an MOF, which is very eager to jump in and try to right-size the FX market?
Yeah, they always repeatedly say they don't look at levels per se. As you mentioned, Danny, it's all about the pace of the move, the volatility. But certainly analysts and traders seem to think this 160 area is something of a red line. But there's no doubt, I mean, even listening to Fed Chairman Powell yesterday, the ultimate message was, there might be cuts this year. But even if there is, realistically, markets are talking maybe one cut of 25 basis points, maybe possibly two. But likewise, Bank of Japan may hike by maybe 25 odd. That interest rate differential is still going to be there. That's what's of course driving dollar strength, and that's what's of course keeping pressure on the yen. So as long as there's this huge divergence in monetary policy between both currencies, that's going to keep pressure on the yen, and of course will test the strategy that the authorities in Tokyo are pursuing.
An increasingly expensive strategy ended. Thank you very much, Bloomberg's End to Current. Let's get back now to Mona Mahajan of Edward Jones and Peter Scheer of Academy Securities. Mona, you look at what the yen did after the BOJ intervened both on Monday and yesterday, where we're basically at the levels that we were on Friday. Is this a losing battle?
Yeah, I think as was alluded to earlier, it will be tough given that there's such a differential between the two policy rates, the two 10-year yields in both the U.S. and Japan. You know, the good news is because the Fed was a little bit more dovish yesterday, perhaps the peak tension between the differential between the yen and U.S. is behind us. If the Fed is heading towards at least 1 to 2 rate cuts this year. And if the BOJ is gradually getting towards 1 to 2 rate hikes in the next 12 months or so, perhaps that differential narrows and that peak tension, as I noted, could be behind us. Now, overall, you know, the Japanese economy has some news or has some good news ahead of it. You know, we are for the first time seeing that economy come out of a stagflationary environment that it had been, you know, prior to the last year for years. You know, low inflation, low growth. We're finally seeing the economy react positively to stimulus. We're seeing growth and inflation pick up. And in fact, you know, the bank is poised for a rate cut at some point in the future, or excuse me, a rate hike at some point in the future. That is a good signal for the economy going forward. Now, the FX markets will have to play out over time, but we think some of the tensions that we had seen really got exacerbated over the past few weeks. We could see those ease going forward.
Mona, can I just say, I have made that mistake so many times of saying the BOJ will cut.
Hikes, cuts,
how do you keep your, I don't know how you keep your head around it, to be fair. Peter, in looking at the interest rate differentials, in where the BOJ is going and where the yen is going, we are in this environment, again, very different from 2022 when they spent $62 billion to intervene, which ultimately, let's be honest, what helped was a shrinking yield differential. The BOJ doesn't exactly have that this time around. How expensive and lasting and useful is this project going to be of consistent intervention?
I actually think it might work this time around. I generally dismiss intervention, think it's not going to work. What I like about this is they seem to be a little bit more strategic, right? They didn't jump in at 145, 150. They've waited till a long time. And if you talk to people, right, almost everyone's sitting there wondering, how much worse can this get? So I think they kind of let sentiment build to a point that it might be easy to push back down, right? They didn't intervene too early. I think they targeted times where the markets are liquid. They had a little bit of good news on their side to try and get the maximum bang for the yen that they put at their disposal. So I would not fight this move right now. I think they are probably going to turn out to be successful in the near term, regardless of rate differentials, because I think they've timed this intervention pretty well, given market sentiment, what's going on. I think we could get back to 150, maybe even the 140s. If they do this persistently, they keep this kind of strategy of trying to time it correctly. I think the intervention will be good for a period of time, and then we'll have to see how the economies play out in the rate differential. But near term, I think this is going to be much more about technicals, catching people offside, and maybe generating the momentum to get some longs coming into the yen.
Peter, I have had so many conversations on intervention, and you truly are the first person to say that it will work. It is refreshing to hear in those that are so negative.
That might be the first time I've ever said it would work. So.
Well, there you go. You're a changed man, Peter. But okay, so it could work this time around. But if you look at what the market has done, you look at after a Fed decision where we push towards 158, is it not traders here that are almost like bond vigilantes, but instead in the yen, Peter, where they are testing the BOJ? To me, that seems a hard environment to operate in and to be successful in intervention.
Yes, but I think, right, we put this time the market's pushed so far, there's probably a lot of very weak shorts in there. People thought, well, maybe this can break 160, maybe we can push it through, but they pushed it through 145. I just feel that when I look at the technicals and the, sound bites I'm catching, this is much more susceptible to a short squeeze than it would have been had they tried to intervene at 145, right? So they've let this market play out, let kind of the shorts get overly aggressive. There's a contingent of people, I think, waiting to pile in long. So I think that's why it's different, right? It's, again, when rates went to 5% last year, everyone talked about all the same things we could talk about now, but you could bet on rates going lower because everything got squeezed. Then people were talking at 4%, they're never going higher again. We're back to 460. These things go through ebbs and flows. It's not one directional. That's why I think yields come down a little bit right now. And I think the Japanese yen can be successful because that's the offsides trade. That's probably the pain trade. And then we can resume those marches higher.
Peter, we'll bring you back on for a victory lap when they are ultimately successful. We're going to have to end it there. Mona, Peter, thank you so much for your time this morning. Okay, coming up, the streaming wars continue. Netflix gets a boost from CCIC. We're going to get your morning calls up next here on The Open.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Whipsaw of a session yesterday, we push higher with the markets now open up 0.8% for NASDAQ futures. The outperformer, here's how maybe confused things are. Despite a Powell who said we're not going to get cuts anytime, what's rallying the most? It is small caps up 1.2%. We're going to get Apple earnings after the bell. Those shares so far higher heading into that earnings report. Now, when it comes to this bond market, not much has changed in the information we got from Powell, so not much has changed in how we're trading this thing. Not even a basis point higher, but we are backing off from 5% on the front end of the curve. So that information, again, nothing to price in there. NYMEX crude up 1/3%. Dollar has been weaker for most of the morning. However, not as weak as the euro. Euro falls versus the dollar. We are at 106 yen. That is also a little change, a little bit weaker after a second day of intervention this week. Now, one stock to watch at the open. It is Peloton. The company has announced that its CEO, Barry McCarthy, will be stepping down. The company will also be cutting 15% of its workforce. Let's get over to Bloomberg's Ed Ludlow on the story. Hey, Ed.
Good morning, Danny, and the stock is reacting positively, up 14.5%, on track for its biggest jump since November. The story in aggregate is basically things are not improving at Peloton. And so Barry McCarthy, who has been through several restructuring actions, is stepping down. As you say, the board will lead a search for a successor. 15% reduction in headcount globally is about 400 staff. The bad news continues. I mean, what's worrying is the full year outlook, where Peloton is essentially telling us that the trend on hardware sales leads them to believe that things will not be good on the software side either. Their estimate for the full year is that connected fitness subscribers will become below the 3.01 million that they'd forecast, in part because they're seeing a slowdown in the hardware offering. The strategy has been like chop and change a little bit. You know, I don't know, since if you moved back to America, Danny, you got on the Peloton yourself. I actually recently dipped my toe back in and got back into Peloton. But there just isn't the volume demand for the hardware, and so the knock-on effect is that the software or subscription side is suffering too. To remedy that, they've tried to go to hotels, do deals with hotel chains where they put the hardware into the gym facility there. That's not really worked either. The good news is kind of a cash flow picture. You know, these headcount reductions result in $200 million of cash savings, and there might be some kind of more positive cash flow picture by the end of this year. But all in all, things have really slowed down, and as one person said to me on social media, if the wheels are not coming off at Peloton, they're not quite back on, although, as I said, the stock is much higher.
I mean, it should be if the flywheel is not coming off, because they don't have real wheels, Ed. So, you know, maybe amend that a little bit. Ed Ludlow, thank you so much. By the way, I did have Peloton at one point. Don't anymore, just in case you're curious. Okay, let's get to another consumer story. It is eBay. The stock is dropping this morning. The e-commerce giant delivered a light forecast for the second quarter. Joining us with the details is Bloomberg's Abigail Doolittle. Abby.
And this weakness, it puts the stock on pace for a third day in a row, the worst 3 days
since October of last year. So investors really not liking the report. Now, they did beat to some degree on the quarter that was reported, but to your point, the guide was a little bit light, especially as it relates to revenue. They put up the forecast for this current quarter of $2.54 billion, whereas the average estimate was closer to $2.56 billion. So not a huge miss, but for this e-commerce giant, some are still wondering whether or not it's from another era that it can't compete with the more modern competition, especially Amazon and Walmart taking some of its share recently. Now, it's interesting, though, Danny, because investors not liking these results so much, at least right now. The stock well off its lows, and its pre-market was down more than 3%. But analysts are okay. JP Morgan saying the results were slightly ahead of expectations. Macro pressures persist but are stable. Morgan Stanley saying that they showed solid micro execution, and then Piper Sandler saying that they remain a buyer of the stock on any pullback. So we're seeing that buying right now. Let's watch the stock as it goes on, Danny.
Okay, Abby, thank you very much. Bloomberg's Abigail Doolittle. Let's now turn to Carvana. It's an auto retailer. It is soaring after posting a surprise profit. This thing's been volatile as of late over the past year. Let's get to Bloomberg's Isabel Lee. Hey, Isabel.
Hey, Danny, soaring indeed, up 38% to the highest since April 2022, and shares are still holding. It's up around 36%. So to your point, the company reported strong earnings and surprise profit, and this comes after the company digs into its restructuring plan and also regains its sales momentum. So Carvana reported net income of $49 million, and this is a stark reversal from the $116 million loss analysts were expecting. And the profit was helped by a $75 million gain in the value of warrants that Carvana holds in Roots, which is an insurance firm. But even without that windfall, analysts are saying that Carvana would have still bested expectations. So Citi said results were impressive. JP Morgan said the continued rapid progress on all fronts is also noteworthy. And for Carvana, the results is really a sign that they're really moving past the period of restructuring and on to better times, which is a position to better grow their business. And get this, Carvana the stock has risen 65% this year and 1,000% the past 12 months, Danny.
Isabel, appreciate it. Isabel Lee there. And finally, let's get to Etsy. It's another one we're watching. An e-commerce giant slipping after earnings delivered weakness in discretionary spending, something we've heard from quite a few consumer companies. Let's get to Bloomberg's Simone Foxman on this. Hey, Simone.
Hey, Danny. Yeah, CEO Josh Silverman saying that higher costs for other items for consumers are denting sales more than expected in the first quarter. They said that this was in line with guidance, but that the range of potential outcomes for this year, they still believe they will see some reversal, stronger second half gross merchandise sales, but that marketing spend is going to be even more important as they try and compete with the likes of Amazon, Walmart, China's Temu. When we look at gross merchandising sales, that's actually the real focus for investors. $2.99 billion. That was 3.7% lower on a year-on-year basis, and slightly under the estimate of about $3 billion. What's interesting as well is the activity. 9.3 million sellers coming in light, as buyers also slightly growing a little bit more weakly than anticipated. We've seen price targets cut across the street, but Morgan Stanley saying that while macro plays a large role in their underwhelming performance, they are a little bit concerned about the internals of Etsy. They would have expected stronger growth in the core marketplace, and therefore there are questions about the long-term growth. They cut their price target to $52 a share from $55, and we're looking at the shares down 15% today, Danny.
Simone, thanks for that. Bloomberg's Simone Foxman. So those are some of the earnings we got today already, but looking ahead, we're going to get Apple. It's one of the last of the Mag 7 to report earnings. It comes after the bell. Then the last report will be chip giant NVIDIA, which comes for later this month. Let's round it all out. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, great to see you. Just looking at what Apple has done this year, it's down nearly 11%. It's fallen every single month so far to start the year. So where is the bar for Apple in this earnings report? Is it low considering that, or do they really need to show up and deliver?
Yeah, I think, again, there are a lot of headwinds that they are facing, and so the estimates have come down. But the real kicker to me is what are they going to show around generative AI? I mean, really, China's story is known. It's embedded in the numbers at this point of time. But if they can come up with, a large language model that's going to feature in their next version of the chip, which they are going to launch another iPhone in September,
That's going to drive huge demand, a refresh cycle that everyone is anticipating, and there is pent-up demand. It's a question of what kind of features can they integrate, and Qualcomm actually, they said yesterday their premium chips are doing quite well, and there is demand for AI features that they have incorporated. So in the end, it comes down to the features and what they can do around generative AI.
Is Apple behind in this, though, Mandeep? Because we know a large part of their team was dedicated to looking at autonomous driving. They had to do a shift in strategy. So where do they stand?
Well, so clearly, when you compare the capex of all the large hyperscalers, I mean, Apple isn't spending any money on NVIDIA GPUs, at least based on their capex numbers. So clearly, they've been behind in terms of investing in developing their own large language model. But from what we've been gathering off late, they are trying to develop a small model as opposed to, the billions of 500 billion parameter models that we keep hearing from GPT and Gemini. And so that's more appropriate for the phone. The question is, can they integrate it in time for a September launch? And I think that's where the CapEx numbers is going to give us some sense, but clearly they are behind.
The CapEx numbers have been fascinating this season, Mandeep. Google, $12 billion. Meta said something between $35 and $40 billion for their forecast. Both Microsoft and Alphabet said they expected to materially increase from where we are. We've seen investors reward that in some cases and punish it in other cases. How thin are investors' patience when it comes to CapEx and actually seeing it turn around into something that is monetized?
Yeah, look, Microsoft clearly is out there in terms of monetizing that generative AI CapEx quite well, and it's reflected in their, Azure numbers, the growth that they showed, $4 billion run rate around Gen AI workloads, add Copilot. So clearly, there is a path to monetization. Meta, on the other hand, has incorporated a lot of the AI features within their apps, and that's actually working quite well for them. The question really is for everyone else, how does that CapEx translate into real monetizable revenue? And the answer isn't very clear because these companies already have a lot of enterprise data and they're able to roll AI services on top of that. That's what makes it sticky. But for anyone else developing their own model or developing something outside, it's very hard to make sure you get all the data and you're able to monetize it right away.
And it's an expensive endeavor because not even are the parts expensive, there are supply shortages. I mean, the chips industry swings between surplus and deficit so quickly. The labor, the talent, it is expensive. So Mandeep, even though we have companies plowing tens of billions into the project of AI, how volatile is it? How volatile is the cycle of chips and incorporating it into their businesses?
I mean, based on what we are reading with the CapEx numbers this quarter, this is not a short-term phenomenon. I think what you are going to see is a steady ramp up. I mean, clearly you're not going to see 40–50% CapEx increases, once you kind of lap these comps. But what they're trying to do is to build capacity. And these models are getting larger and larger in size. I mean, right now, all the focus is on data centers. That's where all the infrastructure lies. Now it's slowly trickling to devices. And look, there is demand, and that's what bodes well for NVIDIA, because even though they have tougher comps, if CapEx numbers are going up 40–50%, a lot of that is going to trickle down to NVIDIA and some other players, but clearly NVIDIA has the chips that everyone wants, and they're still supply constrained.
Okay, Mandeep, we'll see what the numbers tell us today. Mandeep Singh of Bloomberg Intelligence. Coming up, more earnings for you. Tanger reports a strong start to the year as it raises its full-year guidance. We're going to be sitting down with the CEO, Stephen Yalof, on the company's strategic vision. That'll to come next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Has reported a strong start to the year. They had significant growth, a positive outlook, and now they're focusing on diversifying the uses in its outlets. I am pleased to say that joining me now is the CEO of Tanger. It is Stephen Yalof. Stephen, thanks for stopping by. Great to see you.
Thanks for having me.
So in a lot of the earnings that we've gotten, even over the past week, there are signs of concerns about the consumer. We've seen it in food and beverage, McDonald's, Starbucks, even Amazon talked about this. With the consumers, the customers that are coming into your outlets, are you seeing any signs of weakness?
Not in the first quarter. In fact, January, obviously, sales and traffic inhibited a little bit by weather. February came back quite strong, and March even stronger. And I think some of that had to do with the Easter selling season, but spring breaks in both March and April, when people are on the road, moving around, going to some of these resort destinations where we have a lot of our shopping centers, we seem to get a lot of traffic, and we're seeing cars not only during the week, but also extending into the weekends as well.
I was going to say, because I told you this in the break, I remember growing up and passing your outlets on my way to the beach and saying, I think we need to stop here. But how do you change from we're just driving along the way, we happen to see, we go into a destination itself?
Well, what's happening now is a lot of those markets where we have our shopping centers are becoming permanent or growth markets for permanent population. So we're seeing some of the folks that are moving out of cities, moving into some of these, what we would have called secondary locations back in the day, and now markets that are growing at great leaps and bounds. Places like just outside Savannah in Pooler, Georgia is a great example, where we have a shopping center, one of the great growth stories from a local economy point of view. And so we're seeing that tourist customer, that drive-by customer that we've seen for years and years is still coming to our centers, but now we're catering a little bit more towards that local customer who comes more frequently, comes during the week, wants a better food and beverage experience, wants better amenities, et cetera. So these are the things that we're positioning ourselves.
The kind of stores you have, the tenants you have, they do run the gambit. You have the lower end, you have things like Navy, Old Gap, and then you have the aspirational luxury, Kate Spade, Michael Kors. With the types of people that shop there, have you seen a bifurcation in their behavior?
Well, we actually have expanded our catchment. So as we add more aspirational brands, which is what you're referring to with the Kate Spades and the Michael Kors and the Coaches and the Ralph Laurens, there's an aspirational customer that's trading up. So you have folks that probably won't shop those brands in other, in other venues, streets, malls, full price venues that might, their point of entry might be through the outlet because it's on sale every day. And we also see a consumer that's just looking for their favorite brand at the best possible price. So we get it from both ends, and I think that that's the market that we're catering to.
So do you think you're benefiting from a consumer who is quote unquote trading down, but their version of doing that is shopping at an outlet, same brand, but shopping at the outlet instead?
Yeah, I think so. You know, we don't sell commodity in an outlet center. You know, we're not selling sneakers at the best possible price. We're selling Nikes at value price. So our customer is really looking for brand. That's what they want. And, you know, they get those brands that are in our shopping centers. And what's more exciting is that there are new brands that are coming into the business that haven't been in the business before. So last quarter, we announced a whole bunch of new tenants that are fresh and new in the outlet space. And we're excited to bring them throughout our portfolio.
To that point of new tenants, one of the things that we've seen among companies, or among retail companies right now, is kind of the K-shape. Again, aspirational not doing as well, maybe because they're shopping at your outlets now instead, but the ultra luxury have held up extremely well. Louis Vuitton not as bad as some people thought. Hermes doing very well. Is there any desire to get the ultra luxury into your outlets?
Well, sure. You know, we talked about a shopping center in London. You know, there are markets in the country and obviously overseas that have outlet centers that have great luxury presence in them. And yeah, we're ramping up to add those to our centers as well. You know, we are principally positioned in markets that are those drive-to American tourist locations. And the first thing you want to do is make sure that you're merchandising to the customer that's actually shopping in your shopping centers, because we want to make sure that the shopper has a great shopping experience, but also the retailer has a good experience inside our centers.
How hard is it to get one of those luxury folks? Because so many of them are hyper concerned about brand dilution.
Yeah, you know, first of all, the amount of volume that these brands do in outlets is pretty staggering. So it's probably not as difficult. But, you know, it's really a question of what is the availability of excess inventory, because for the most part, where those particular brands are just selling excess.
Who do you want to get? I need to know this, Stephen.
My number one?
Yeah.
You know, I would say that there's a whole host of Italian brands that I think would do absolutely fantastic in your hometown of Washington, D.C. And, you know, so we're obviously out front working on brands like that.
Okay, well, I'm excited to see that. Now, elsewhere in this world, I mean, we've come out, perhaps, of a real estate crisis, of concerns over CRA. It isn't completely gone. The Ares CEO, for example, told me it would take years for it to really figure itself out. If there are continued tensions, issues with real estate, are you ready to jump on opportunities and expand and buy up more real estate?
Well, last quarter was a great example of that. You know, we bought 2 properties, one in Huntsville, Alabama, which was our first non-outlet property. And we bought the outlet center in Asheville, North Carolina, which is our hometown. So, you know, as opportunities present themselves, our balance sheet is in great shape. We just redid our lines of credit. So we really have access to capital. There are significant partnership opportunities out there for us as well. I think people like us as an operating company. So we have best-in-class leasing, marketing, and property operations. There are a number of owners that, you know, outsource a lot of that operational muscle in order to run their properties. We bring that in-house. So we think a little bit more strategically. We think a little bit more long-term. You know, we like to think like general merchandise managers. That's how we run our properties. We run them for the long term.
What about geographical exposure-wise? Is there anywhere that you'd want to be more into that you're looking at specifically?
Well, you know, we like the South. And, you know, less susceptibility to weather. People at the shop, the outdoor, we're an open air REIT. And for the most part, when we can find really good property in the South, we can extend that selling season.
Okay, well, let me know when the luxury gets to DC. I'll pay you a visit. Stephen, thank you so much for joining.
It's my pleasure. Thank you so much for having me.
Thank you, Stephen Yalof, the Tanger CEO. Okay, now let's get to some of the price action this morning and get over to Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Danny. So overall, we are looking at a small gain for the S&P 500, up about 0.4%. Actually, I should say a modest to solid gain for the S&P 500. Most sectors are higher, led by technology, up more than 1%. This is Apple, Microsoft, NVIDIA, and many others are up. And of course, we'll be watching Apple all day ahead of those earnings later today, given the fact that it has been down every month this year. To the downside, materials down about 1%. Mosaic and a number of the other chemical companies are down. Actually, Mosaic being a fertilizer company, but some of the chemical companies are lower. As for one sector that's outperforming on the week, heading to its best week in 2 months, take a look at biotech. Down just a little bit today, but this week, again, the best week since early March. And a lot of this has to do with Moderna Moderna, a good quarter. This index is trading higher in part because of Moderna's quarter. Danny.
Hey, Abby, appreciate it. Abigail Doolittle. Okay, coming up, we're going to get you some of the market-moving events that you need to be watching. That's up next in our trading diary. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We are about 30 minutes past the open. We're up by about 0.6% for the Russell. That outperforms the NASDAQ. That's up 0.5%, and S&P up by 1/3. NASDAQ, we're bracing for Apple earnings. Tomorrow is jobs data. By the way, we are seeing options that are pricing for the most volatile jobs day in about a year, with Powell opening up the gates to no cuts being priced out this year. Okay, let's get your trading diary, what you need to be watching for the rest of this week. So at the top of the hour, we're going to be getting March factory orders and durable goods. This afternoon, we get Apple earnings after the bell. Tomorrow, we are going to be rounding out the week with the U.S. jobs report. The estimates at the moment are for 240, 241. Is this a still hot labor market? Powell yesterday saying that he needs to either see a cooling in the labor market or inflation down to target in order to start to cut. All right, this was the countdown to the open here on Bloomberg.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. This is the Bloomberg Intelligence Radio program. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City to our worldwide audience. A lot of earnings. We're going to break it down. A lot of tech earnings. Qualcomm, we're going to talk about that. And we're also going to have the CEO around 11:35 Wall Street time. Cristiano Amon, Qualcomm CEO, is going to speak with Bloomberg technology anchors Ed Ludlow and Caroline Hyde. So that's around 8:30 Wall Street time. So that's going to be cool. We're also going to speak to some smart folks and see what they thought about Fed Chairman Jay Powell. His comments yesterday seem to be walking back on talk of a rate hike in the markets like that. The S&P 500 is up about 0.25% this morning. All right, let's kick it all off with a Bloomberg Business Flash from Mr. John Tucker.
And this Bloomberg Business Flash being brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Right now, the major stock indexes, they are higher. S&P 500, 8 points higher. That's up 0.1%. 5,026 on the index. The Dow Jones Industrial Average is 83 points higher. That's up 0.2%. And the NASDAQ 100 right now, 38 points higher, a rise of 0.2%. Megatech shares leading the rest of the market higher. You have shares of Apple. They were up about 1.7% ahead of their earnings after the close of regular trading today. The focus, among other things, is going to be on iPhone sales in China. The semiconductors, among the best performing group of stocks, you have Qualcomm shares. They are up right now over 8.8%, a strong forecast from Qualcomm. And then you have shares of NVIDIA. They are up right now about 0.8%. Fresh data suggesting U.S. inflation could remain elevated. Unit labor costs today rising the most in a year during the first quarter. We got those figures this morning as productivity moderated. And then you have Peloton Interactive, the CEO, Barry McCarthy, stepping down. The company undergoing a major restructuring, cutting the global workforce by 15%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That
Peloton user?
Yes,
of course he is.
Like I
he has
said.
the bike, he has the treadmill, you got all the things,
And the right handle is for the suits. The left handle is for the pants.
So that's a no.
It's a very expensive clothes
Well,
hanger.
we say this, but Paul Sweeney has one.
In the household, yeah.
He's got all of it. Look at how cut and chiseled Paul is.
My
weird.
girlfriend
I didn't
is
mean to roll my eyes.
crazy. Karen is a crazy Peloton person.
Or Qualcomm, I guess maybe they use chips.
chips.
But here's what's interesting is that how much, so their whole point is let's be a subscriber base, or there it was, right?
Yes.
We don't have to depend on these big chunky hardware things to sell that are expensive, but it's services, right? How much would she pay for subscriptions? Like, what's the ceiling?
I don't even know what she pays. That's the thing. So it's a subscription model, like anything else, cellular telephones, cable television. It's the same model. Number of subscribers times how much you'll pay per month or whatever like that. So how do you grow it? You grow your subs and you grow your revenue per month. Well, post-pandemic, pretty much everybody, that's a problem. There hasn't been any demand post-pandemic.
Right.
They had that surge, and then it came off. So now you're down like every other service out there, pricing.
Right.
And how do you raise prices? How do you create more value to support a higher price? That's their challenge. When I've spoken to management, I've just said, hey, however many your audience is out there, hundreds of thousands of millions, whatever it is, they're passionate. I mean, they're great. The social media interaction that users have with these personalities, these instructors, is unbelievable. How do you monetize that?
Like, how do you upsell? Like, can you upsell that?
I think you can.
Right.
I think you can. And there's merchandise and things like that, but something really big. How do you take that user base that is passionate and has this visceral relationship with your instructors and monetize that?
Well, here's my question, too. Can you do all of that without the equipment?
Right. So they've already when they started this business, they had it fully integrated. They did the machines, they serviced the machines, they delivered the machines. They got out of that business because that's a very capital intensive business. So they kind of got away from that when the business started shrinking. I don't know. I think it's just be an asset light and try to increase the revenue per user.
What does a trainer make?
I don't know. And if you Google it, you get
I know
a
what I
million
pay my
different...
trainers, but they're not Peloton trainers.
Because I'm thinking about this.
You have a trainer?
I have 3 trainers, Pilates trainers.
3 trainers?
3 Pilates trainers, yeah.
You got to invest in yourself, John.
Invest in
That's
yourself,
what we're learning.
in your face. There's a lot of investment that happens.
John, and how many
But I
trainers...
don't have any money to invest in myself.
But it's all relative. But I would have to think that because they know that those trainers are superstars, they're probably paying them some
These
superstar
trainers,
money.
by the way, they're all young, they're all smart, they're all great looking.
Yeah, I was like, they're all pretty.
And they figured out a way to create their own brands and monetize that and do lots of other stuff. So they are very good. They probably make most of their income away from Peloton. They use Peloton to... So anyway, it's a fascinating business. Crazy group of people, but, it's fun. They're passionate.
That was a great
Stocks
conversation.
down. Yeah.
Happy Happy Thursday.
Yeah, very good. Nice to see you.
Happy Friday Eve. Lovely to be here. So lots of other fun stocks happening. Carvana, Qualcomm, Etsy, DoorDash, tons of stuff to kind of dig through. Norma Linda joins us from Bloomberg. You're looking at Carvana. Man, that is a move.
A big move. We're seeing those shares surging 40%. This is the highest since 2022. And this is coming after better than expected profit and sales from the company. It reported net income of $49 million, which is a massive beat against analyst estimates for a loss of $116 million. It essentially grew vehicle sales for the first time in 6 years. So we do have investors cheering the stock on. JP Morgan actually lifted its recommendation on the stock to overweight from neutral. It says that strong sales and margins should put to rest any lingering concerns about its ability to reduce its debt burden over time.
All right, look at this price chart. And for those of you on the radio, that doesn't really work. But if you look at it, basically from 2017 to 2020, it was like $40, $50 stock. And then it spiked up during the pandemic as people were scrambling here, and there's a shortage of cars, to over $350 just during the space of 2020 and 2021. And then it dipped all the way back down to almost zero by the end of 2022. Now we're back up to $116. So that's been an unbelievable roller coaster. But it seems like they found their footing now.
My question, though, is that they sell an annualized run rate is below 400,000, but they recondition like 1.3 million cars. They have the capacity to do that. I don't understand how those numbers eventually make sense in this environment where rates are still really high, right?
Yep.
So you think that auto loans would be very difficult for buyers to come by. Anyway, so I feel like that, speaking of, we're talking to the CEO later on Bloomberg Television at 3:30, so I will ask him this question.
Yep. All right, buddy mine's on the board there. I haven't spoken to him, but it's been a wild ride for those folks. What else we got?
Let's look at Qualcomm. Of course, that's the talk of the day. We have the Qualcomm shares up for their biggest gain and highest intraday level in 2 years. Of course, this is the world's biggest seller of smartphone processors, and it gave an upbeat forecast for sales and profit for the current quarter. This is huge after the company has pretty much been weathering rather tepid demand over the past 2 years. The CEO has really been trying to push into personal computers to decrease its reliance on phone chips, but it's still heavily dependent on demand for handsets, and that's particularly in China.
Another crazy stock chart. I mean, we're at a 52-week high for Qualcomm, $178. The all-time high was about $183 intraday. So it's been all over the place. But again, 52-week high today for Qualcomm. It's not a small stock. It's sitting right at $200 billion in market cap. All right, Norma Linda, thank you so much. We appreciate it. Norma Linda does all the stocks for us. She's from Bloomberg News, joining us here in studio. Let's break it down a little bit more on Qualcomm. Angelo Zeno joins us, Vice President and Senior Equity Analyst for CFRA Research in New York. Angelo, what's your takeaway here? The market certainly likes what they saw from Qualcomm. What's your takeaways?
Yeah, no, we love it. You know, we upgraded the stock to a buy actually on the news. I mean, typically, you know, we hate upgrading near the highs for a stock like this, but it's warranted. And I think kind of the biggest takeaway on our end is this is a company that is clearly going to see some significant diversification away from smartphones over the next couple of years. I think a big concern of ours was eventually Qualcomm would lose that Apple business, right? As Apple kind of starts, you know, internally designing their modems at some point in time. It might be a 26, 27, 28 thing, but it would happen at some point in time. But that said, you kind of look at what they just did here. Android ecosystem is definitely coming back, specifically in China, grew north of 40%. More importantly, I think the numbers that they gave out for that automotive pipeline, extremely impressive, kind of growing from 30 billion 18 months ago to about 45 billion now. That provides some really nice visibility as you go into 2026 and beyond. And then you guys highlighted the AI PC opportunity. And I think that's a really underappreciated story. They didn't throw any numbers out as far as AI PCs are concerned and their opportunity there this quarter, but they did say that they were going to start throwing those type of numbers out next quarter. So I think that also is a potential catalyst that we can kind of see as they kind of go into their you know, June quarter results in July.
All right, a lot to break down on that, and we'll get to Apple in just a second. But where did we learn from Qualcomm of where we are in the smartphone cycle?
Yeah, I mean, as far as the smartphone cycle is concerned, hey, listen, this is a market that we think is still peaked out in 2016. We don't see it getting back to those levels anytime in the near future. But that said, I think what the real key takeaway here for Qualcomm is concerned is we're looking for low single-digit growth as far as the smartphone market is concerned. But more importantly, the mix, especially on the Android side of things, will continue to kind of shift towards more premium end devices. That's something that Apple has clearly benefited from over the years from a broader smartphone market. But as we kind of see that increasingly take place on the Android side of things, specifically from AI-related smartphones, that provides greater content growth for Qualcomm. So Qualcomm will be able to outgrow the smartphone market here over the next couple of years, we think, because of that, you know, the content gains that they're seeing, unlike what you're seeing from the likes of, you know, Qorvo and Skyworks, which is just, you know, the last 2 nights, you know, reported results that were pretty abysmal.
Hey, Angelo, just a naive question for me. I just don't know the answer. But I do know they sell a lot of chips into China. Is that a risk for them? And if so, how do they mitigate it?
Yeah, I mean, that's a great point. I mean, geopolitical risks are always out there. And, you know, I think, you know, it's been an issue that kind of Qualcomm has had to contend with. I mean, they were more, you know, relevant in, let's say, you know, Huawei's ecosystem here years ago. And you kind of look at what they said last night, and they're essentially going to be completely gone from Huawei phones by the end of this calendar year. So I think in some respects, they're going to be forced out, you know, in certain instances of, you know, certain devices out there. But yeah, I think that's a great question. I don't know if there's a way of necessarily mitigating that risk out there. But, you know, in the same respect, a lot of kind of the chips that they sell into China are also not necessarily getting sold into the China market. They're getting kind of pushed out and kind of getting sold across the rest of the world, even if they are China-related phones. But it is it's a risk out there over time, absolutely.
You mentioned the AI PC cycle, which leads us to sort of the AI smartphone cycle, which leads us to Apple, trying to connect all those dots for us. I'm trying. I don't know if that worked. But what kind of AI computer, AI phone cycle do you think we could be under, and when does that kind of hit?
So, as far as Apple is concerned, I think this is an absolutely massive opportunity for them here in calendar 2024. And, the way we would look at it is, listen, the results here are going to be tonight are going to be what they are going to be. We don't expect anything good. But as soon as next week, you're going to start going into a refresh cycle of iPad announcements. You're going to see Developers Conference in June, and then later this year, we do think you're going to get on-device AI smartphones on the iPhone side of things, as well as another upgrade cycle opportunity on the Mac side of things. So this is a really interesting opportunity because we expect them to refresh essentially their entire hardware ecosystem here over the next kind of 8 to 9 months. And we do think that is underappreciated to an extent. Whether or not kind of consumers are going to go out there and actually upgrade their devices to these kind of AI-enabled devices remains to be seen. It all depends on what exactly Apple kind of rolls out. But we know they're going to put some crazy marketing power behind all of this, right? And we do think that there is potential for them to kind of at least increase pricing across certain aspects of their ecosystem. So that should also kind of help support an improving revenue trajectory as we get at least into the iPhone 16 cycle later this year.
So in reality, though, Angela, what can the company say today about China? Can they say, because I think it's unclear whether their challenges in China are from competition, from, changing consumer behaviors relates to buying Chinese products or anti-American products. I don't know how to kind of phrase that out or parse that out. What can they say? What's the market hoping to hear?
Well, I'll tell you what I'm hoping to hear, and that would help me in terms of kind of the China story. We think China revenue declines are probably going to be closer to 15 to 20%, which is worse than expectations out there.
Wow.
But more importantly, I think is going to be exactly what they have to say about the China ecosystem out there and kind of what they have to say about the installed base. If they can kind of come out and say, hey, listen, we're seeing significant declines out there. And maybe part of it is because, hey, listen, you've got some tough comps out there. Maybe part of it is they don't have an AI-enabled device out there where other China OEMs out there are kind of rolling out their AI-enabled devices out already. And then, of course, the Huawei play. But they can come out and say, hey, listen, the installed base continues to remain either the same or incrementally grow out in China. I think that would alleviate some of the concerns out there about the China ecosystem, at least for us, and would also support the view that this might be more of a cyclical thing than a secular structural thing.
Okay, here's my question. I have an AI smartphone. What is that going to do for me that my phone doesn't do now? Do we know the answer to that? Angela, do we know that?
I mean, listen, I think when you kind of look at you look at what the S20, I think, the most notable kind of AI-enabled phone that's out there right now, at least from my understanding, is the S24 with Samsung, and they've got some kind of incremental, changes out there in terms of, supporting multimodal capabilities, translation, all that kind of stuff. It's not necessarily anything groundbreaking in nature, right? I think what's going to be more important, at least from Apple's perspective, is what they can kind of do in terms of things like, content creation, imaging, all that kind of stuff. Will it kind of get some of the Gen Z population out there a little bit more interested in potentially upgrading towards these devices? But to your point, is there anything kind of earth-shattering right now, some kind of killer opportunity out there on the AI side of things? I think that remains to be seen. It all depends on what some of these OEMs kind of come out with and showcase that to consumers.
I don't know. Is it gonna do my laundry for me? Like, I mean, you gotta think about these things, right? Oh man, do my taxes. All right, Angela, thanks a lot. Angela Zeno, Vice President and Senior Equity Analyst at CFRA Research, joining us there. Apple stock is up about 1.2% ahead of earnings today. We're kind of rolling over here. We had a nice pop earlier, and now the S&P is relatively flat, or it's up by 1/10. But if you look at that chart, it's been a little straight line lower there, despite you had Jay Powell yesterday saying no hike, no cut, which should, in theory, be good for equities. The bond market not going anywhere either. I'm taking a look at the 2-year. You're seeing a little bit of buying, yields down by about 3 basis points. We're going to talk about all this coming up with Carol Schleif, CIO at BMO Family Office. We'll discuss her outlook for the market, what she makes of the Fed, and what she makes of jobs tomorrow. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. With us, Bloomberg Business Flash. The major stock averages, they are higher, but they're pairing the earlier gains that we saw. The Federal Reserve said it's likely delaying cuts to interest rates, but not planning to hike them. That was the reason behind the earlier pop that we got. Then you had the tech stocks, strong earnings reports from several big companies. Qualcomm, those shares were rising over 8%. They topped forecasts for profit and revenue in the latest quarter. They also gave forecasted ranges for upcoming revenue and profit, the midpoints topping analyst expectations. And Apple, ahead of its earnings report at the close, they are pushing higher. DoorDash sinking over 12%. They reported a worse loss than expected. Best performing stock in the S&P 500. Actually, I had to look this up because I'd never heard of them. From Eden Prairie, Minnesota, C.H. Robinson Worldwide, the trucking company, logistics company, up 17%. Overall, S&P 500, as Alex said, pairing earlier gains, right now up 6 points. That's up 0.1%, 5,024 on the index. The Dow Jones Industrial Average, 89 points higher. The NASDAQ 100 right now up 27 points. That's a rise of 0.2%. Let's do yields real quick. 2-year, 3 basis points lower at 492. The 10-year unchanged, 462. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. So nice to have you back at your normal time.
Actually, I'm filling in for Lisa, who was filling in for me. So I guess I'm me now.
Yeah, so he's not Lisa, he's himself.
But I'm Lisa again tomorrow, who was filling whatever.
Don't confuse us.
I'm confused.
I thought there was a bird in the radio studio, so definitely don't confuse us.
Yeah, we had to question what you were like.
It wasn't a bird, it was a clamp. Anyway, I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We're live from our Interactive Broker studio right here in Midtown Manhattan. We're also live on YouTube, so go ahead and check us out. Okay, so the market's kind of rolling over a little bit here. We got through some earnings. We do have Apple after the bell. We get jobs tomorrow. ... Then what? Like, what's your big takeaway? What's going to be the next catalyst? Joining us in studio to discuss is Carol Schleif. She is, where's the thing? There we go. CIO at BMO Family Office. I knew it was there in my email. Carol, I don't think I've ever seen you in person.
Always dialing in.
I'm
right?
hiding out in the Midwest a lot. No,
This is very exciting.
Yeah, it's very exciting for me. I love being in studio.
Okay, great. Well, Carol, it's great to see you in person. What is going to be your next catalyst that you're looking for within the market? We keep getting through these big events to little or no fanfare. So what's next?
Well, and I think the most interesting thing is to take it up a level, and instead of focusing on every piece of data, because the Fed has kept us really data dependent for a very long time, is to focus on the overarching trend. And there's lots of really interesting things going on intermediate and longer term, especially this, even though it's talked about, it's largely underappreciated, the secular trends we've got going on in infrastructure build, not just infrastructure, but also that implies that we have to build data centers, which means we have to hook them to the grid, which the grid, is difficult getting them hooked. So energy play, utilities, there's lots of different ways to play this. And you can make an argument that this is the biggest infrastructure spend or the biggest productivity potential boost we've had since we put the interstates in the 50s and completely changed the complexion of the United States. And so there's lots of stuff going on there. It can be easy to get caught in the near term. We've got an election coming up. We've got more Fed meetings, more data, but it's important to pull out of that and keep a longer term perspective.
William Woods University, Fulton, Missouri. Awesome.
I was an equestrian science major. I thought I was going to be
equestrian science
a horse trainer. Yep.
Exactly. Wow. And you're running money.
Well, I did get a business degree while I was there too, so I double majored.
So was the science in relation to equestrian stuff, or was it like dependent?
It was. I wanted to run the barn, not just train the horses, and so there was. And then I found I loved my business classes, and I loved being based in the Midwest because I do know who C.H. Robinson is, and I know who a lot of those other companies are there.
Are you based in where are you based now?
Yeah, I'm based in Minneapolis.
Based in Minneapolis.
Yeah.
Nice. Okay. Okay, let's say we want to play infrastructure. Let's say some of those great Midwestern industries. How are you guys playing it? How are you getting exposure here?
We've got we've had an important, specifically called out in an ETF, an actively managed ETF, PAVE.
Yeah.
I like that.
Which is, and then we actually, another iteration is another actively managed ETF, the AIQ index is one of the ways we've been doing it. There's a lot, you can own the ETF, you can own the individual securities. We do have a lot of clients that own individual securities, lots of ways to play it. But there's also the structure around it. One of the other things we're focusing on from a global standpoint is trying to get to even a neutral weight in Japan when most of the world is underweight.
Right.
Because when you look at the Japanese indexes, they're much more technology heavy than the European, the other developed markets, which are more industrial. or utility or old school. So there's lots of different ways to play it, both individually as well as just leaning into those sectors.
And so PAVE, if you look on your Bloomberg terminal, it is Eaton, it is Parker Hannifin, United Rentals, Emerson. I love these guys.
Right.
They're they do all the things.
Well, and it
Yeah.
was
Isn't it Karen
when we
Ubelhart
were
thing?
looking for a way to play it, we specifically searched out who are the ones that are going to be based on that rebuilding in the United States. And it's interesting. It was watching C.H. Robinson's earnings, actually, where I first learned that Mexico was our biggest trading partner before the news was announcing it, because they were putting $500 million facility on this side of the border in Texas to help move that stuff.
What's something we have heard, though, in a lot of these conference calls is that there's no doubt a structural shift underway for these industrial guys as they take advantage of the CHIPS Act and the Infrastructure Act and et cetera. But it's still a cyclical industry. And so a lot of these companies wind up having, say, a strong backlog, but they're not like booking the orders right away. Like they're not making the kind of money now that we thought they necessarily would. How do you think about that?
Well, I think it's important you get that same sort of push and pull in the artificial intelligence, because on the one hand, 3 years from now, we're going to be really happy that these big, deep-pocketed companies are spending on infrastructure, but in the last earnings round, we nailed some of them because they're spending on infrastructure to put that in. So it is the advantage we have is that we're investing very long-term money, and so part of it is managing the expectations in the short run with clients that, here's what we're building for the long run. We know it might be volatile in the short run, and so we'll dollar cost average into some of these positions, take advantage if they blow up on an earnings report or something like that. But it really is, you have to stay out of the day-to-day frenzy, if you will, and focus.
So at BMO Family Office, for those who don't know, BMO is Bank of Montreal. So I'm guessing by the name you have a lot of Canadian clients.
We actually, we're the U.S.
You're the
part
U.S. part, okay.
of the family office, and it was BMO in the U.S. had Harris Bank from Chicago, so there's a lot of team in Chicago.
So is there a difference between risk tolerance for a Canadian investor versus a U.S. investor? Do you look at them differently?
Oh, that's interesting.
Stocks, bonds, alternatives, that kind of thing?
Yeah, interesting question. Canada tends to be very resource-based, as you can imagine, and so there's a lot of emphasis there. There is a difference, too, in the individual space somewhat, but, it's no different than any couple that sits down across from us. There might be different risk tolerance there, where one wants to be a longer-term investor and one wants to trade on the latest
So do you like energy?
Looking for a friend.
Yeah. Energy is definitely an interesting play, and there's some of the, we've got really good energy and commodity analysis. We've been having a lot of conversation for copper for a very long time about overcapacity, undercapacity, and it's hard because, to your point earlier, they are cyclical industries. There's going to be those cyclical flows, but having cyclical operations inside a secular trend is more positive if that secular trend is bringing everybody up. So the backlogs are building. Energy's tough because it's politically charged for a lot of where do they invest? Do they give back to shareholders? How do they participate in the transition of the grid? So,
how about healthcare? I see that in your notes here. I mean, you kind of highlight biotechnology, and I always said, boy, biotechnology, that's a tough place because it feels like it's binary. It either passes and the stock goes ripping, or it doesn't pass and it goes to zero. How do you guys get exposure there?
Well, I think overarchingly, biotechnology is interesting, as are for the artificial intelligence implications that you've got in drug delivery and drug discovery and med tech discovery and things like that. There are, again, actively managed or passively managed ETFs are ways to play it. We don't necessarily call it out as a secular theme in our portfolios. But healthcare in general, especially when you start thinking about the long-term implications and the second and third knock-on effects of the GLP-1 drugs, in terms of, do we need less diabetes drugs? Do we need fewer knee implant replacements and surgery there as we move forward? So it's really fun to think about those long-term trends.
Really, yeah, that's so great. It's like you get the opportunity to think of all the derivatives that are going to come after, which is really, really great.
Most importantly, English or Western settle?
Western.
Oh, okay. Is there a dividing line between?
There actually is 4 seats. There's hunt seat, saddle seat, Western, and then dressage.
Okay.
So
learn something.
Is one of them riding backwards?
No.
Hook up with Katie Greifeld.
Katie Greifeld. They could do a whole equestrian podcast.
She's dressage, yeah.
With Gus, her horse.
That's fancy.
I've been on the horse like a couple times. That's all I got. Carol, it was so great to see you. Thank you so much.
Great.
Come back. Really wonderful talking to you.
Thank
Carol
you.
Schleif, Chief Investment Officer over at BMO Family Office. All right, coming up, we're going to talk about Intel investing in Ohio when it comes to chips. That's the big take next. This is Bloomberg.
All right, let's get word on national news right now with Mr. We're going to do that. I'm going to do that. Mr. Barr. Michael Barr's back behind the bar.
Thank you very much, Paul, Alex, John. Former President Donald Trump's hush money criminal trial resumes this morning in Manhattan. It's centered on alleged efforts to suppress negative stories and influence the outcome of the 2016 election. Loyola law professor and former federal prosecutor Lori Levinson.
There are several other witnesses that could be called, and we don't know exactly the order. We know that there were others that were involved in the transactions, or perhaps those who were advising Trump regarding the Access Hollywood tape. So the next witnesses coming up could be very straightforward regarding the financial transactions, or they could be blockbusters, like Stormy Daniels or Karen McDougal.
A hearing just wrapped up on whether Trump violated the gag order. Again, prosecutors are seeking $1,000 fines for each of 4 comments by Trump that they say have violated the judge's gag order, barring him from attacking witnesses, jurors, and others close to the case. That is on top of a $9,000 fine the judge imposed on Tuesday related to 9 separate gag order violations. Police in tactical gear moved in on protesters on the UCLA campus this morning. While some demonstrators left, others did not. Former LAPD police officer and former Los Angeles City Council member Dennis Zine told CBS he believes some of those who clashed with police were outside agitators.
Many of those people want to be arrested. They will be arrested. They're there what they believe is a cause, and I would question how many of them are actual students versus agitators.
Police have removed barricades and begun dismantling pro-Palestinian demonstrators fortified encampment. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. Wall Street traders awaiting tomorrow's jobs report for clues on the Fed's next steps. In the run-up to the monthly employment report, data showed labor costs, they actually jumped the most in a year. Productivity gains slowed. So that adds a risk to the idea that the inflation will stay higher for longer. Ahead of the earnings report from Apple, those shares up 1.6%. Qualcomm, the world's biggest seller of smartphone processors, they delivered an upbeat forecast to the close of regular trading yesterday, also suggesting demand handsets. The demand there increasing after a 2-year slump. Berkshire Hathaway investors, they're going to gather in Omaha Saturday for the annual meeting. A noticeable void on the stage. Charlie Munger, Buffett's longtime business partner, right-hand man. He died back in November, just months shy of his 100th birthday. S&P 500 right now, 13 points higher. That's up 0.3%, 5,031 on the index. The Dow Jones Industrial Average up 130 points right now. And the NASDAQ 170 points higher. That's up 0.4%. With the data today, 2-year yield, which is more policy reactive, that's down about 4 basis points. We're at 4.92. The 10, unchanged, I'll call that, 4.63 right now. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the news you need to know with great insight from our Bloomberg Intelligence team that cover about 2,000 companies and 130 industries worldwide. We also do something really special on Bloomberg called The Big Take. And sort of daily, we put out something that's really in-depth, also very timely, with great reporting. And this Big Take also coincides with the lead in Bloomberg Business Week, and it has to do with Intel committing some serious money into building a factory in Ohio. Joining us now is Max Chafkin. He's a senior reporter for Bloomberg Business Week, and he co-authored this piece with Ian King on Intel committing all of this money in Ohio. And you can read all of this at Bloomberg and on Bloomberg.com/Big Take. All right, Max, walk us through the piece, what it's about, and what you learned.
All right, so Intel, at one time was one of the world's largest companies. It is essentially one of the founding parts of Silicon Valley. It's the reason it's called Silicon Valley, in fact. But over the last decade, Intel has really suffered. They've sort of fallen behind both the big chip makers in the U.S., NVIDIA, AMD, and they've fallen way behind on manufacturing, behind TSMC and Samsung. And that's a big problem for Intel, this large, important American company, but of course it's also a problem for the United States because Intel at this point is the only company making state-of-the-art chips or even trying to make state-of-the-art chips in the U.S. And over the last few years, they've pursued basically a turnaround, and that turnaround is betting entirely on manufacturing. You mentioned the project in Ohio. President Biden has talked about that a fair number of times, including bringing it up in the State of the Union address. There are also major, tens of billions of dollars projects in Arizona and Oregon. And this work is being backed with a lot of money from Washington, $19.5 billion in grants and loans from the Biden administration. So it's this big, ambitious attempt to turn around, a really important company that's fallen on some hard times. It's also a big part of the White House's geopolitical strategy.
They're going to build a mega fab. What is a mega fab, and can they actually? Are they going to get it done here? Because this is big numbers.
So Intel's put $28 billion into this Ohio site so far. The site is it's about 45 minutes north of Columbus. It's in a bunch of farmland. It's really muddy. You go there now, and what you really see is just a ton of construction. The idea of a mega fab would be to have multiple chip factories. Each one of these things, you're talking on the order of $10 billion. They're going to build 2 to start. And it sounds like a crazy amount of money, but at this point, that is what you need if you want to be able to compete to make chips, say, for the iPhone or for AI chips, to try to compete with NVIDIA, which Intel, really desperately would like to do, but it just isn't quite there yet on the manufacturing side yet.
We have heard, though, of a lot of companies announcing projects and manufacturing facilities that don't get done, or the timeline's pushed out, or it gets pared back. Where is Intel in that?
Yeah, we saw this, of course, during the Trump administration. You know, there has been like a political shift over the last, I'd say, decade, where there's a lot more enthusiasm, both from Republicans and Democrats, for sort of state-backed industrial projects. Not all those have gone great. I mentioned this story that one of the sites that Intel was looking at was this Wisconsin site outside of Racine. People will remember that because Donald Trump called it the eighth wonder of the world 8 or 9 years ago, talking about Foxconn. You know, Foxconn opened there, but it hasn't proven to be the job creator they want. And there's a risk with this project as well. I will say, these semiconductor factories, they are like some of the biggest and most ambitious kinds of factories you can build. There are already, like I said, it's muddy. There's not a lot going on there right now.
Literally and figuratively.
There are already, 1,400 construction workers working on that site today. Long run, they're saying it's going to employ something like 7,000. And